counted as part of the U.S. non-farm payroll statistics, for instance. So in relations to these statistics, how reliable they are, yes, there's a lot of discussions about some of the issues in measuring the employment in the U.S. We focused mostly on the payroll statistics that covers a very broad sample, much broader than the so-called household survey that is used for the unemployment rate, but it's also much more noisy, much less reliable, we think, to count the number of jobs created over time. So we focused very much on the payroll survey, and all our estimates went to try to assess as best as we could the contribution from immigrants.
I'm glad you brought up humanitarian immigrants, because there's 3 different, or 5, in your note you put it as 5 different types of immigration. There's people that overstay, there's visas, there's green cards. When you see this uptick in surge, is it coming from the humanitarian? Because likely that's the one that's going to get the biggest political backlash. That's right. It is really these humanitarian immigrants, that category of individuals that has really surged over the past 2 years or so, and especially last year. And we expect this to have continued in the first half of this year, and they will continue to contribute to payroll gains in the second half of this year, despite the fact that President Biden initiated this executive action that stops the flow of immigrants to the southern border. And the reason for that is this 6-month delay I was alluding to before. Right? The people who have come in the first half of the year will likely get a job in the second half of this year. And so we think that that's going to contribute to growth gains in the second half of this year. I mean, this note again, Mark, it's so fascinating, the research you've done. And I know you spent a lot of time on the labor supply, so forgive me for this question. We've talked a lot about the labor supply, but what about the demand side? Has there been a noticeable difference in this economy by just having more people here? Very good point. Yes, so we've seen on the demand side, I would point to the JOLT survey, for instance, the job opening, labor turnover survey, that has shown, for instance, 12 million job openings back in 2022. And this has, we've seen these numbers gradually come down. We had about 2 job openings per unemployed back in 2022. We have only 1.2 job openings per unemployed. And this is where the immigration story comes back in. We think that a lot of these job openings were filled by immigrants. So it's not that they necessarily took jobs away from US born. They just filled the gap, the shortage of workers that we had 2 years ago that has gradually dissipated. So what we are seeing is labor demand gradually coming down, the labor market in that sense really moderating, the tightness of the labor market really coming back to normal. We have firms hiring now at a pace that's roughly in line with what we had pre-pandemic. We have individuals also quitting their jobs to find another higher paying job at about the same rate as what we had pre-pandemic. So all of these statistics have normalized. The labor demand has normalized. But again, we think that this has benefited very much from this immigration flow that has filled this gap. I'm glad that Danny was talking about the demand side. And it's the demand side for goods, and the demand side just for, in general, things that the U.S. has and produces, but it's also demand for housing. And this is something that is key as far as an input to the inflation data. How much do you think that some of the housing price stickiness is going to be something long-lasting, in part because of how many people have come into the country? So that's a great point. So we think that there is overall a structural shortage of housing in the U.S. economy. And there was a shortage of housing in 2019 already. The point is we hadn't built much housing in the whole decade following the great financial crisis. So we are now stuck with a relatively low stock of housing. And that's going to, and now as more people enter the U.S. and enter the labor force and need housing units, we have a structural shortage of housing. So that's going to maintain what we think a floor under the house prices. This is in part why we haven't seen, we think, like house prices really drop significantly. In fact, they dropped just a little bit in 2022 when the Fed started tightening its policy and rate hiking campaign. But then house prices stabilized and went right back up. And we think this is really reflecting this
underlying strength in demand and this continued strength in demand.
And Jonathan Miller was talking about that as well. Mark Giannoni of Barclays, thank you so much for being with us. That was really fascinating, really interesting research. We're going to be speaking with Andrew Skrowski also. He is from Eaton Vance, talking about some of the housing data. Katie Kaminsky is going to be joining us. Andrew Skrowski of Eaton Vance, Bloomberg's Craig Trudell, and Leslie Falconio of UBS. All of that is coming up in the next hour of Bloomberg Surveillance at a time where the market is trying to cling on to weekly gains, but just losing a bit of steam here to end the week. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's really about a couple of stocks or a small number of stocks that are having an outside effect on the markets.
There is an underlying risk, just that folks have gotten so bullish about the AI theme.
We're not necessarily at peak bubble levels, but there's definitely sort of a whiff of bubble about it.
Let's face it, this is the biggest, mega trend that we have today, and you either going to implement artificial intelligence or you're going to be left behind.
You can't stand in the way of that freight train of mega cap tech. You just can't do it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Is the U.S. economy weakening or weak? The gap in understanding that question is getting narrower and narrower. Welcome back. This is Bloomberg Surveillance. Emery Herdern, Danny Berger, Lisa Abramowitz. John Farrow will be back next week. We are seeing a bit of exhaustion in this market as it really has hinged mainly on one stock. Danny, to me, it feels as though people are starting to lose confidence that NVIDIA can power record gain after record gain for the foreseeable future.
They're losing confidence, but they're also putting all their money into tech and NVIDIA, so it is a market of dichotomies. Dean Curran over at Macro Risk Advisors calls it a period of raging quiet, and this I like because, you know, we can talk about NVIDIA selling off, the market weaker yesterday, but in reality, this market refuses to lose steam. We haven't had a single 2% down day for all of 2024. And there's only been 7 days where we've fallen by more than 1%.
Roaring quiet maybe at the index level. Under the hood, a little bit less than that kind of quiet, perhaps a little bit more. This, to me, from Deutsche Bank's Jim Reed, really stood out. The fact that, Emery, only 2% of the S&P 500's 503 constituents are currently at all-time highs or near that. 7% are at one-month lows. We are talking about complete bifurcation in the haves, NVIDIA, and the have-nots. Pretty much everybody else.
Exactly. Exceptionism for maybe one or two, a handful of names when it comes to the U.S. stock market. Stifel put out this note talking about that the S&P 500 may rally close to 10% this year. They're looking at 6,000 before the end of the year, but they're talking about the fact that this is overdone and it's a bubble. And then their call for mid-2026 is a 4,800 level, basically erasing a fifth of that value that they think we're going to get to at the end of the year. But anyone who could look into a crystal ball for 2026, good luck.
Yeah, well, if they can look into a ball for, say, next month, I'd be very grateful, because right now the sort of discussion around weakening versus weak is growing increasingly loud. Something that you mentioned, Danny, that I thought was important, the City U.S. Economic Surprise Index turning the most negative going back to August of 2022, as we have seen sort of a downward shift in a new way. It seems as though maybe people weren't expecting the economy to weaken quite as quickly as it seems to be doing.
It did sneak up on us, but I gotta say, I feel like if we'd been listening to the companies, we might have seen it. And I mean, you all discussed it here, so you definitely saw it. Corporations, especially consumer-facing ones, saying something has changed. Something has changed in consumer habits. And we're seeing that pick up with some fuel. McDonald's now offering $5 value menus. Hertz is talking about trying to get cheaper cars into its fleet, so because people aren't paying up for the more expensive thing. It's kind of like a shrink disinflation thing sort of happening, of companies trying to maintain their margins, but also cater a consumer who's more budget conscious. But what point does that just turn into all-out margin deterioration?
And how much is this sort of an idiosyncratic story of the haves and the have-nots when the corporate sphere? Hertz right now looking to pay about 13% on a junk bond in order to raise money to offset some of the losses. Here's the state of play to end the week. We are seeing just marginal gains, particularly on the NASDAQ for the full week. Can we continue with that given the weakness we see? It is early days. The S&P clawing back some of the losses, down only about 0.1%, 55.40. The euro, keep watching this space. 106.83. Terry Wiseman yesterday coming to set and saying that he sees 105, albeit not very far away from where we are, but this steady grind weaker of the euro potentially poised to continue on political risk, as Anne-Marie has been highlighting. And 10-year yields going downward about 3 basis points, 422.64, as people take a look at some of the sell-off from yesterday and continue to see bonds as a haven. This is something we're going to pick up in just a second. And crude just marginally lower, but just hovering north of $80 a barrel, $81.20 on the NYMEX. Coming up, Katie Kaminsky of Alpha Simplex on a roller coaster first half of the year for Treasuries. Andrew Sizarowski of Eaton Vance following weak housing data, and Bloomberg's Craig Trudell. Cyber attacks, more of them, shut down car dealerships across the U.S. If you want to buy a car, you might have a bit of a delay. We begin with a top story. Treasury's looking to erase this year's losses as investors ramp up their rate cut bets. Katie Kaminsky of Alpha Simplex writing this: fixed income short signals begin to dissipate as yields moved lower on a better than expected CPI print and hopes for a rate cut. Katie joins us now. Katie, someone who was incredibly brave to go short bonds when everybody else was going long, who talked about the potential of 10-year yields getting to 6% just simply on trend following. You've noticed a shift of late in Treasuries, hinting at more of a long position. Can you tell us what that shift is and how much conviction you have around it?
Well, Something is very different this month, Lisa. And what we've seen, as you pointed out, weaker economic data. Secondly, we're starting to hear some murmurs of demand destruction. What does that mean from a technical perspective? It means that we've seen synchronous sell-offs in the cross-asset space. So that's in the agriculturals, also in the metals, but particularly rallying in yields. Rallying in bonds, and really a big adjustment in the yield space. We've seen risk-off behavior, which we hadn't seen most of this year. And so if you think about that, it really feels like the other asset classes are telling us something about the economic picture that we're still not seeing in the equity markets. So for us, this means that signals in fixed income have really started to dissipate for the first time since the beginning of this year. To me, this looks a lot like an inflection point and a pivot where we might be looking at some sort of sea change for markets that we hadn't seen before.
Katie, this is fascinating at a time where a lot of people are wondering that difference between weakening and weak. You're saying the signal from a lot of asset class, and you point to commodities in addition to some of the individual corporate moves that pointing to some kind of weakening that was unexpected or weak, not just weakening. What does this do in terms of your conviction to say, go long bonds, pull out of a lot of different equities, particularly those that have been the highest flyers?
Well, I think the big challenge is seeing risk-off type of behavior in the market is an indication that for the first time this year, the market is starting to get nervous about the potential or higher probability of some sort of harder landing. And that wasn't in the data before. So when we saw weaker data, it usually meant relief. It meant that we might have cuts and that we could get a soft type landing that we wanted. Right now, what you're seeing is this type of flee to bonds is leading to change signals in fixed income and causing people to be more likely to be long to kind of hedge the potential risk that we might have a correction, particularly if you think about the equity markets where there's such a bifurcation in the sense that valuations are very high, even though we're starting to see stabilization of a lot of economic data. So that's something that we haven't seen stabilize and nobody would like to stabilize, but multiples remain high as data starts to get back to normal.
Katie, it's also been interesting to look this flee from bonds as you talk about of who's been fleeing to bonds. Just looking at the ETF flows, we're on track for TLT, that's the BlackRock Long Bond ETF, to put on its best month in terms of flows so far this year. So you do have households buying bonds, you have hedge funds buying bonds. So it's clear with all this discussion of who's going to buy all the bonds out there, people are, but the type of people who are buying it are price-sensitive buyers. What does that do to the volatility of this bond market when those are the types of folks who now are the majority owners of this market?
This is a good point because we have really seen bond volatility remain elevated since COVID, or particularly once we started to see higher rates. And you see in a slightly higher inflation environment, there's a lot more bifurcation of buyers and sellers. And before it was much more focused on rate cuts, but now it seems that people are also embedding some sentiment in their flows, meaning that as they get concerned about the high valuations in equities, you start to see that risk-off pattern where people think about bonds again as a safety trade, something to lock in if rates go up or if something goes wrong. And we end up in a situation where, like Lisa said, weak is actually weak, means weak economic data.
What does that do to an automated strategy like your own? Because you can see a clear trend, perhaps, of people going out buying bonds. Bonds rally, but it's more volatile. It's not as staid as the market once was.
This is definitely an issue. When you have higher volatility, it means that you have less conviction in general in signals, and we've seen that in fixed income. Fixed income volatility doubled in 2022, and it's still up at elevated levels, which means that the overall direction of fixed income has been difficult to follow. And you can see that by looking at the graph this year. Being short was the right call until recently, and now it looks like the trajectory of bonds is actually lower yields, and that suggests that technical strategies, they're just picking up on price behavior and where markets are moving at the moment. And markets are definitely moving somewhat towards this risk-off hedging bets against equity potential weakness.
Katie, you have some research on potentially how the markets could trade with the upcoming election. A third of CFOs in a survey yesterday we learned see the elections impacting investments. Given the fact that we're on the edge of waiting for potential cut from the Fed, and we still don't know the outcome of this election, how do you position for this?
So positioning for elections from a technical perspective is actually quite tricky, but it's really about following whatever the prevailing price trends are, and they usually tend to be pretty strong around volatile environments. So I think this fall, what's going to be interesting is going to be to see how does the market, how do people react to how the election unfolds, and what potential trends might emerge. And it really feels right now, because of the uncertainty around this, that there's a wide range of outcomes, which means that there could be very interesting trends in the fall. Could it be long bonds? Maybe. Right now, it's starting to hint that that could be the case and that there could be much lower yields. But of course, we got to wait and see from the data if we actually see that pivot in fixed income positioning completely to long.
And when it comes to the election, as Greg Vallier told us earlier, potentially this is going to be dragged out for weeks and potentially not knowing the actual makeup of what Washington is going to look at. Bank of America today has a note talking about the zeitgeist, and it's if there's a clean sweep, there's this potential concern about a Liz Truss moment. But whether we get Trump or Biden, how much are you starting to take into account the concerns about the U.S. fiscal deficit?
Well, this is a great question this week because, as you know, sort of numbers came out this week in the bond market and people have been watching it because with deficits up, there's definitely concern about valuation and fixed income. So people definitely have their eyes on fixed income markets. So I think there's going to be a lot of focus on auctions, and there's also going to be a lot of questions about how does that impact the overall valuations of U.S. fixed income. So again, that goes back to the point, things are very volatile for fixed income. It is not an easy trade like it used to be, a simple risk-off asset. In a world of inflation with high deficits, bonds are just not as easy to call. And I think that goes to the volatility point, plus correlations being positive this year so far with stocks.
Katie, just to put a bow on it, earlier this year you had pretty high conviction to be short bonds based on the trend following. Now you're seeing a pivot point. Where is your conviction level? Can you have conviction in the near term to be long bonds?
I think in the near term, it's definitely very mixed, but you have seen a pivot. We have seen more long signals in the European debt and international debt. So that to me is sort of ahead of the curve in the sense you've seen the cutting in the ECB, you've seen other central bankers cutting, which has definitely pivoted those particular markets to long. I think the U.S. curve, especially with the cautious Fed, still remains a short view in the short term. But if we continue to see evidence of risk-off behavior, you're going to see that pivot as well.
Katie Kaminsky of Alpha Simplex, thank you so much. As always, great insight. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. A United Airlines flight leaving Connecticut had to turn back shortly after takeoff after a piece of its engine cover fell off yesterday. Crew members saying they heard an abnormal noise after departing aboard the Airbus A320. United says a part of the engine's sound-dampening outer liner was later found on the runway at Bradley International Airport near Hartford. Donald Trump raised more money than Joe Biden for the second straight month in this election cycle, pulling in $141 million compared to President Biden's $85 million. The contributions have come from online donors, billionaires, and super PACs, with investor Timothy Mellon donating $50 million the day after Trump was convicted. President Biden's campaign is still flush with cash, having $212 million on hand entering May. Trump and the RNC have not disclosed their total on hand. And Red Bull is looking at ways to expand its sporting empire, considering a bid for a new NBA team. Bloomberg reporting the deliberations are focused on an expansion franchise in Las Vegas, which could cost more than $4 billion. Red Bull already has significant experience in sports, owning 2 Formula One teams as well as football clubs in Germany and the U.S., though an NBA team would likely be its biggest asset yet. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, home buyers waiting on the Fed.
When you see rates cut, you're going to see a surge, at least in the short run, you're going to see a surge in demand.
That's coming up next. This is Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Coming into the heat of summer, literally and figuratively, with trying to eke out additional gains after a real kind of motley performance over the past week. S&P futures lower by about 0.1%, 55.38. You've seen this bifurcation pretty consistently, with NVIDIA leading all of the gains up to this year. Something like a third of all gains have been attributed to one name that has gained about $2 trillion in market valuation. Now the question is, how far can it continue to power a rally that is showing signs of exhaustion? Exhaustion also in the Euro region, with PMIs coming out showing weakness, possibly because of what's happening politically. Although, Emery, as you pointed out, there are some questions about how much this was already in the pipeline. And what you see on 10-year yields, just marginally lower, about 3 basis points at 4.23. Under surveillance this morning, home buyers patiently and not so patiently waiting on the Fed.
The last 2.5 years have been this era of pent-up demand that suddenly the sort of legs are cut out from under the housing market, and people that were in the process of thinking about it were stopped in their tracks, and everybody's waiting. When you see rates cut, you're going to see a surge, at least in the short run, you're going to see a surge in demand.
Here's the latest. Investors waiting U.S. existing home sales data due out at 10 a.m. Eastern after housing starts and building permits yesterday showed a slowdown to a 4-year low. Andrew Cizorowski of Eaton Vance writing this: the home buyer needs to come to terms with the fact that 2010 to 2022 were the anomalies for mortgage rates. Don't expect to get a 2.5% mortgage ever again. Lack of supply is keeping home prices elevated in most markets. That is unlikely to change. Andrew joins us now. Andrew, your note was bleak, I've got to say. Fascinating research, but rather bleak for anyone who wants to buy a home, considering the fact that we're talking about massive increases for mortgage premiums that you're paying every month if you want to buy a home at these values and at these rates. And in your view, you don't see that going down much, do you?
Yeah, look, I think we talk about mortgage rates, and obviously they went from 2.5% to 7% and near 8% at their peak. All that has done is kind of locked a lot of renters out of the market, and it's also prevented people from selling their home because they don't want to have that mortgage shock. You know, your mortgage has gone from up almost 150% from moving from where we were in 2020 when you factor in between home prices and actually mortgage rates. And so that's a huge deterrent to actually moving. And so the Fed's killed housing activity. It hasn't killed home prices because ultimately there's just no supply on the market and there's still some demand. And so that's you look at the commercial real estate market, it's a much different story. But for the actual housing inflation, the Fed's desired goal it didn't actually occur because essentially there's just no supply on the market. That's unlikely to change when you look at home builders have actually pulled back a little bit on building, and that's just we already have this underbuilding problem, and that's just gonna kind of further exacerbate that home price gains going forward. So normally you would have expected this huge mortgage shock to actually create this big decline in home prices. This is one of those cases where if there's no supply, there's still some demand. We can't get there.
Which raises a lot of issues, in particular about inflation going forward, considering how significant a part of some of the inflation reads housing costs are. So from your vantage point, do you see real relief on that front? The sort of expected disinflationary kind of trend that a lot of people have saying will transpire in the rental market, will happen with housing prices. Are you saying it's not going to happen?
Yeah, look, I think we're going to continue to see a moderation in rental inflation. I think we'll see. I think we'll actually see home prices kind of slowly moderate from here. Again, not decline, but come down from the kind of 5-6% level to maybe kind of 2-3% level. And I think that's on the right path for the Fed. Again, I think the problem is that we have this kind of underbuilding problem. We have, over 1.5 million households being created on an annual basis, but we're only building 1.2, 1.3 million homes. And so there's that shortage that still persists. And then you add in immigration, and it kind of further exacerbates that problem. So for the Fed, though, it's killing activity. I think the Fed's on the right path. I think that, they never would have dreamed that you could go from 2.5% to 8% mortgage rates and not have home prices fall. But again, there was we went up by so much. The average mortgage holder has a mortgage rate sub 4%. And so it basically, if we had just gone from 4% mortgage rates to 5%, there'd be a lot more housing activity than there's today. I think the flip side of it, though, is if mortgage rates continue to decline from here, which I expect they will, that you could actually see if mortgage rates fell 50, 100 basis points, you could actually see activity pick up, and without actually home prices kind of taking another leg higher, just kind of continuing on the path they are.
In that scenario where we are seeing mortgages come down 50, 100 basis points, choose your range, Andrew, is that enough, though, to have home builders come back in force? Because as you say, they're not chasing prices right now. So does that change with lower rates?
Yeah, I think one of the interesting things you're seeing with home builders is if you actually look at the average square footage of a home that new home builders are building, it's come down from just under 2,800 square feet back a decade ago to around 2,300 square feet today. So I think home builders are actually trying to meet the home buyer at a better price point. They know that the affordability is way down because of mortgage rates, and I think they're trying to do a little bit of their part there. But I do think that you're probably getting close to a bottoming in housing activity. Again, housing starts and permits are down, existing home sales are way down, but I think that we're getting close to a floor. And as mortgage rates decline, if the Fed starts cutting rates as well, I think that'll give home builders a confidence to kind of pick up for that kind of coming cycle. I think the issue is, though, that look, we live in a country where we've already had kind of a lot of people who kind of moved out of cities, and builders have been kind of buying outside of these regions, whether that's 20 miles, 30 miles, 40 miles out. And then at some point, there's not enough land to keep kind of building at the same pace as you were, unless you're going in the multifamily route. And that's an area where it's a much different market when you look at the multifamily market, where I mentioned kind of commercial real estate prices, but in multifamily, a lot of those buildings could be down 25%, 30%, because at the end of the day, your end investor is looking at what their capitalization rate is today and what their opportunity costs are. And if you could buy a high yield bond at 7-8%, are you going to buy a building that has a yield of 5% at the end of the day? It just doesn't make as much sense anymore.
Andrew, if mortgage rates do come down and we see a flood of people trying to get on the housing ladder, wouldn't that mean that prices are going to go up? Because the demand at this moment is not there for that scenario.
Yeah, look, I think the scenario where home prices go down is kind of it. Look, we would have already seen it by now, and so it's tough for home prices to actually fall. It's just a question of how much will they grow going forward. And so, yeah, I don't think home prices are going to fall in any scenario other than a kind of a pretty severe recession where you ultimately would need the end consumer. You would need unemployment to pick up substantially. Absent some big increase in unemployment, it's unlikely that home prices fall. You could have in certain regions that ultimately you're seeing in certain regions they're kind of moderating. They might fall a little bit, but on a national average, it's very unlikely to see any home price declines without some severe recession. That's the one trigger that could actually get you there, but that's not something I'm forecasting in my projections.
Andrew Cicurowski of Eaton Vance, thank you so much for being with us. Truly wonderful insight at a time where this is what we've heard 2 days in a row, that basically if you're expecting for some reason housing prices to fall significantly to make it easier to get in, Anne Marie, it's looking unlikely that that opportunity is going to present itself.
Looking unlikely that opportunity for Danny and myself. Of course, those who are on their 3% fixed mortgage. The question I have for those people is, if you wanted to move, do you wait for mortgage rates to come down? But still, is that enough to want to give up your home? This is where the question is, where's the supply going to come from?
Speak for all of them, Lisa.
Basically, if you have a much higher valuation on your home, you're doing a much better job, which gets into a whole division, frankly, of people who are younger and don't have sort of a home under belt versus those who aren't, which is some other issue that's frankly figuring into the polls quite significantly. Coming up, back-to-back cyber attacks shutting down thousands of car dealerships across the U.S. We'll discuss that with Bloomberg's Craig Trudell. This is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
quiet week trying to eke out gains after a bit of softness yesterday and this morning. Really just seeing stocks treading water here, although coming back from some of the earlier lows. I mean, basically flat. 55.42, always kind of funny seeing people say, we see the bullish call for markets at 5,600 by year end. Doesn't look that bullish given where we are right now. NASDAQ futures completely unchanged. NVIDIA uncertain as to whether it wants to come to the rescue of the rest of the markets. And Russell 2000 eking out a bit of a gain, a bit of an outperformance and a reversal of what we've seen over the past few weeks. In the bond space, you can see 2s, 10s, and 30s. Yields lower across the board, down just marginally, about 3 basis points on the 2 and 10-year yields as people await some of the S&P Global PMI data, which potentially could show the weakness that we saw over in Europe, or at least weakening trend that a lot of people say might not be major data, but seems to be very heavily traded when there is an absence of anything else. And when you take a look at the euro, crossing below that 107 mark is really this political risk grinds, weighs on what we're seeing with the shared currency. 106.86, down about 0.1% to 0.2%, given some of the political turmoil and the sense that maybe the weakening that we've seen in Europe is not over in terms of just how much it can recover at a time of increased price pressure and also geopolitical turmoil. Under surveillance this morning, CDK telling car dealerships they are likely to be without software services for several more days. This comes after 2 cyber attacks in the company, which serves almost 15,000 dealerships. Bloomberg's Craig Trudell joins us now. Craig, what is this? Basically, people using pens and paper to try to sell vehicles that are entirely registered on internet-based systems?
Yeah, CDK is not necessarily a household name, but if you're in the car industry, and particularly if you're a dealership or close to dealers, they're a huge player in the space of providing what's called dealership management systems. And, that's, sort of a way of referring to basically all of the back-end, systems that you need to line up credit checks or insurance for customers or track down, replacement parts. Basically everything a dealer needs to run their day-to-day business is run through these dealer management systems. And there's only a handful of players. And so for one of them to go down, it's hugely disruptive to the car industry. And we've just, heard reports from across the country that this has really sort of led to this standstill and, as you've alluded to, kind of a return to the Stone Ages of, having to do business with pen and paper.
This raises also this issue of cybersecurity, especially given some of the other hacks we've seen with other types of providers at a time when cars are increasingly a national security risk. At least that's the word from this administration. How protective are some of not just systems to manage selling cars, but also the systems within cars that really manage and frankly operate most of the vehicles that we drive at this point?
I mean, it's a great question, and it's kind of ironic because CDK has kind of billed itself to dealers as, a provider of software that helps them with cybersecurity and protecting their customers' information. And so, this is a case of a company that, this was kind of supposed to be their role, was to be a place for, dealers to put customers' data and information and, trust that it was going to be kept safely. And so, we don't know a whole lot at this point about, the extent to which customer data has been compromised. But we do know that the National Automobile Dealers Association is absolutely pressing the company on this and the extent to which, their members are affected. And, dealers themselves are telling us that, this is a concern. We had, one dealer tell us in a story that just moved onto the terminal, allude to the idea that, he estimated probably 50,000 customers have their data stored in CDK as a result of, the years of business they've been doing with this company.
Craig, do we know who was behind this cyber attack and also how long these car dealerships are going to be dealing with this, going back to the Stone Age of pen and paper?
Yeah, we don't have a lot of information at this moment about who is behind this. But what we do know is that CDK, just as of last night, notified its customers that it did expect this to continue for several days. And so, this first, first brought down their systems on Wednesday, which was really an inopportune moment because the Juneteenth holiday would have otherwise been a really busy day for car dealers. A lot of people are off and, have a bit of time to go through the rigmarole of maybe buying a new car or getting their car serviced. So that was disruptive to, Wednesday. We're now going into a weekend, for end of month and end of quarter push. So this is not a good time for dealers to be without the system that they need to run their business.
Craig, just to take a step back, and Lisa alluded to this too, we're at a time now where cars are more complex than ever. They've got beeps, they've got boops, they've got screens, they've got cameras. They're very confusing. So in this moment in time, how important has the dealer become? How important has it become if you have a car and you run it on the road, that's great, but you can't just go to any old shop to get it fixed? Has the relationship fundamentally altered?
I think it is the case that, people think about, GM or Ford having customers' information, and that's not necessarily the case. I think, the manufacturers have absolutely wanted to get more in on that sort of pipeline of very valuable data, but they work with franchise car dealers who are actually the sort of front-facing, closer to the customer companies. And, so it absolutely is the case that these, cars have more of their customers' information in them. Some of that information is increasingly getting to the manufacturers themselves, but a lot of that, intel on people who are buying new vehicles is ending up with dealers and companies like CDK that we don't necessarily talk a lot about, but I do think that this, series of hacks is only going to sort of spotlight these handful of companies that are left in providing these services.
Bloomberg's Craig Trudell, thank you so much for being with us today. I'm sure we'll be catching up with you throughout next week as we get more tariff announcements like the one that we got earlier, in addition to potential cybersecurity. All right, under surveillance this morning, former St. Louis Fed President Jim Bullard saying the latest CPI report has brought a September rate cut back into play, adding that he expects the pace of cuts to be slow amid no sense of urgency in the real economy. Danny, this is fascinating to me. There is sort of this real push-pull right now on the Fed. This idea that on one hand, you can be patient, they've gotten it wrong. At the same time that Katie Kaminsky of Alpha Simplex is saying, this is a pivot point, and you're seeing the market kind of wake up to downside risks in a way that it hasn't for a long time.
I mean, I could understand the cautiousness, though, because we had a lot of hot data the first quarter. As I said before, if they were reactionary, maybe they even would have hiked if they would have cut in the face of this data. But sometimes I think we confuse the idea of central bank hawkishness with just caution. It's not necessarily that we're hearing them being hawkish, it's that they're just uncertain. This goes back to what Seth Carpenter said yesterday, that it is not a time where you can give a clear outcome, you can give a clear forecast, and he tells them it's a mistake to do so.
Forget September. Have you seen the two large wagers for potentially a July move? It's attracting a ton of attention because how big they are. Obviously, if you look at WIRP, it looks like July is not a live meeting, but even people are starting to now talk about it, that maybe it's not just one dot at the end of the year because of the hard data. And what is it telling us?
Yeah, and maybe this market is unprepared for a couple of real weak prints that are not expected, akin to some of the recent hints we've seen in some of the data. The Department of Justice, meanwhile, dropping one of two claims against TikTok proposal by the FTC, dismissing allegations that TikTok misled consumers about data privacy and planning to focus instead on a lawsuit over children's privacy violations. This to me is also a really interesting story, Anne-Marie, as someone, a mother of children who use TikTok. Is sort of, on one hand, politicians hate it and they want to ban it. On the other hand, it's an incredible tool for them to reach the young people. So it's sort of, which is it and what's the legality versus the politics?
And both campaigns and lots of politicians, whether you're red or blue in Washington, D.C., are using TikTok to try to gain that attention of the youth voters. Bank of America this morning talking about how Gen Z and millennials are actually the biggest voting bloc now, more than the boomers, so it's important. When it comes to this story specifically, what's interesting is that when the Justice Department decides to represent another agency in court, it has its own authority to decide which litigation is going to be better. So potentially they think this is one that they can win rather than the other.
This is one of these interesting ones, though, that this has come up before with TikTok. They had settled on this and said that they'd work with the government. I also saw yesterday TikTok released the brief for their lawsuit against the Biden government. And it kind of goes back to this thing. They say, look, we've tried to work with the administration. We've tried to do things to address voter safety. They had apparently a 100-page national security government draft, where they basically said, government, we will give you a kill switch if you decide that we are a threat. So giving the government a lot of power, and they say they wouldn't work with us. And I wonder if we can look at this lawsuit and say, Maybe they're not working with TikTok. Maybe they are just full force going after them. Of course, we don't actually know that. We don't actually know what's happening behind the scenes, but at least this is the case that they're starting to try to build.
Yeah, this really explains also why it's so difficult to really get a handle on what political risk there is, not only just when it comes to markets and tariffs and things of that nature, but even specific companies, when it's unclear what the will is and then what the ability is, given some of these specifics. Talking about will and ability, if you're getting on a plane, yet another one, United Airlines flight leaving Connecticut had to turn back shortly after takeoff yesterday. A piece of its engine cover fell off aboard the Airbus A320. United saying a part of the engine's sound dampening outer liner was later found on the runway at Bradley International Airport near Hartford. No one likes these stories. How much, and this is something that, Danny, I know you're not necessarily, haven't done a PhD in airplane maintenance, but, you know, this is sort of a question of, is this partly because some of the planes are older, they're not getting replacements? Is it because they're overwhelmed? Is it because certain airlines are having difficulty finding all the people? I mean, what are you looking for in this kind of thing?
It was 22 years old. It was a plane that was probably too old and probably shouldn't have been in the sky. It doesn't mean that you're necessarily unsafe. It means that there'll be delays. Can I just say one statistic that actually maybe is more frightening? Maybe this won't comfort any of us, but the drive to the airport is more dangerous than getting in the plane itself. I think that's, you know, if you plan to drive instead of fly, it is more dangerous.
What I do know is that the aviation industry is under immense pressure. When I first saw this, I had to say, the first thing I did look at was, is this another bad sign for Boeing? Oh no, it's an Airbus that this an issue is. But the FAA still has a review under security, safety concerns at Airbus as well, and United, on United. So there's just a lot of concern about what's going on right now in the aviation industry. I just have to say, when I saw this, I was thinking Boeing must be breathing a sigh of relief.
Yeah, although at the same time, I also wonder if we had these kinds of incidents all the time and just no one was paying attention to them, and now it's basically any anecdote people can have to throw into the mix of, oh my goodness, what are we gonna do? And then everyone gets their planes anyway. Right now, let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakas. Yahaira.
Hi, Lisa. 4 oil refineries in southern Russia were targeted overnight in one of the largest drone attacks since the war in Ukraine began. The Russian military saying that dozens of drones were intercepted and destroyed over Crimea and the Black Sea. One of the refineries targeted was reported to have been damaged. Ukrainian drone attacks against refineries have been increasing over the last several weeks, with at least 2 other facilities damaged in southern Russia. Canada is the latest country set to announce tariffs on Chinese electric vehicles. People familiar with the matter telling Bloomberg that Prime Minister Justin Trudeau is preparing the measures after announcements from here in the U.S. and EU. The value of Chinese EVs imported by Canada has surged to more than 2 billion Canadian dollars from less than 100 million back in 2022, according to Statistics Canada. Yesterday, Ontario Premier Doug Ford called on Trudeau's government to act, saying the EVs are a risk to Canadian jobs. And Kylian Mbappe looks set to play in France's Euro 2024 clash against the Netherlands today with a protective mask, but it won't be the one he was hoping to use. Mbappe broke his nose in France's opening win over Austria and had hoped to play wearing a mask displaying the French team colors he's been wearing during training. However, tournament rules say any protective equipment must be a single color and be free of team identification. That's your brief, Lisa.
Wait, hold up. Thank you so much, Yahaira. We appreciate this. So he can't look like Captain America. Is that really what we're learning?
Captain France.
Yeah, Captain France, Lisa.
Sorry. It's a little bit unfair. The guy is playing with a broken nose, right? He should be able to wear the mask he wants to wear.
It's a little bit distracting. It's a little bit distracting.
He's playing for France, and he's wearing a mask that represents a French flag.
Is he going to put a cape on him, too? I mean, honestly, at a certain point.
Good for him. He should put a cape on him.
That's Anne-Marie Herdman there. Up next, looking for a soft landing.
If we get the impossible dream, which is the Goldilocks scenario of a soft landing, that has to imply the yield curve renormalizing.
Still a lot of discussion here about Mbappe's mask. Coming up next, we're going to be talking about what's going on in the economy. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got
intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Still discussing Mbappe's mask and trying to understand the psychological effect, both for the people playing against him, but also on him. I'm sorry, but playing with an injury, just pause for a second. How are you going to be just as aggressive in order to protect your nose while also potentially winning?
And potentially you're in pain. Do you really go in for that header thinking, oh, this is going to hurt so much more?
Yeah, but I mean, it's for the glory of the country. You can sacrifice your nose just to play.
It's for the Euros. And maybe that's out, so it's all depressing now.
The economy, under surveillance this morning. We're also looking at what's going on in bond yields, not just Mbappe's nose. Under surveillance this morning, looking for a soft landing.
Higher for longer earnings allows markets to stay here, even though we're going to get higher for longer rates. If we get the impossible dream, which is the Goldilocks scenario of a soft landing, that has to imply the yield curve renormalizing.
Here is the latest. U.S. Treasury is coming close to erasing losses for the year as investors await upcoming S&P Global PMI data. Leslie Falconio of UBS writing this. We anticipate 2 non-recessionary cuts in 2024, starting in September, with economic growth and inflation slowing. We think investors should invest cash and money market holdings into high-quality corporate and government bonds. Leslie joins us now. To me, this is sort of the key question. Do you go into bonds as a bearish bet on the economy at a time where we have weakening data, or is this still the Goldilocks soft landing of just rate cut adjustments?
Well, I mean, listen, I think it's a little bit of both. I mean, if you look at what the yield curve has done since the beginning of May, what have we done? We've bull flattened, right? We've had a strong payroll report. And by the way, you know, the market was expecting or pricing in 2 cuts before the Fed meeting and 2 cuts after the Fed meeting. The only thing that changed was that terminal rate that came down, right? So the market is expecting this slower growth and inflation outlook. That doesn't mean that you're going to have a hard landing. So we do think that interest rates are going to start to come down towards the end of the year as we have this drop in inflation, as growth slows but stays above trend. And I think really the issue is where you go in the part of the curve. While our sweet spot is sort of that belly, that 5-year part of the curve, you know, we have no problem extending out, you know, up into that 10-year area.
At this point, when you talk about a bet on duration, this really has come down to often this idea of the disinflation, the idea of a Federal Reserve that's cutting. Can you have that conviction, though, on the very long end, given some of the disagreement that we've heard over the past few weeks, just in terms of whether we're going to see another bout of inflation, about supply chain disruptions, about a whole host of potential risks heading into 2025?
Listen, there's no question. I mean, if you have, the risk is that we have this reflation scenario, and like you mentioned, supply chain disruptions would cause goods inflation to go back up again, and obviously that's part of the risk scenario. But we do believe that overall there's enough demand from insurance companies, pension funds, foreign entities into treasuries, and I know you often talk about the deficit, for example. I mean, when we talk about supply coming into the marketplace, it really has to be above what the market is already expecting, and we view the supply and the deficit as a passenger, not a driver. Now, if you have a scenario where either you have a reinflation or really strong growth above consensus and supply, then that's when you come out with that sort of like bear steepener kind of movement, which obviously would be a risk to our scenario. But we just don't think that's going to be the case. I mean, we really do believe that inflation comes down, that growth comes down, and that supply, which will be high, but the market's expecting that, will actually have, good demand from domestic and foreign players.
I mean, there's something very similar that Steve Major said that, look, it's already in the price as it stands. Leslie, if I could just throw another risk in there of those that we are monitoring, the price of oil, especially as we head into a hot summer and those disruptions. What could that do to your call on bonds if we see a serious pickup in prices?
It's not just about the pickup, it's about the sustainability of the pickup. And we do expect, you're going to see bouts of, pickup in oil prices, but it really needs to be sustained for it to impact inflation over the long term. And as we know, I mean, no one is expecting necessarily a straight shot down. We've had 2 great CPI numbers. There's things that are looking positive in terms of, as we talked about, jobs coming down, which should lead to lower wages going forward. The Manheim Index is coming down. But that doesn't mean, to your point, that you could have these bouts of increases, whether it's in oil or gasoline prices, that might cause a little bit of vulnerability. But over the longer term, right, we really think that trend will be down. We've had 2 good prints. It's not enough for the Fed to move, obviously, in July, nor do we think that they should, but we definitely think September's on the table.
I mean, it's this weird environment because, okay, you could argue on one hand that those sort of risks can cause volatility on this bond market, but on the other hand, as you point out, this market has come much more in line with the Fed than where it used to be. So when it comes to volatility in this bond market, you see in the options market, it is extremely low. Have we passed not the peak in yields, but the peak in volatility?
I think so, and that's a great point, particularly for us who own things like, agency mortgage-backed securities, or anyone owns an instrument that would be considered, short vol. You've had so much reassessing and repricing from the fixed income market, which is forward-looking, versus the Fed, which is backward-looking. They've had a lot of intraday volatility, but we do believe that going forward, that volatility, should decline. You're going to have pockets of vulnerability, there's no question. But most of that vulnerability and volatility came around those CPI numbers, right? But we do think that now and going forward, the projection and print should be much closer than what we've seen in the first quarter.
Leslie, we've been talking a lot about the data. It's softer, not soft, weaker, not weak. Do you now think we're moving into it's soft, it's weak, we're seeing these trends?
Listen, I go with the weak or not weak, and that's definitely going to be our trend. I mean, we do expect growth to slow, but the market coming in expected growth to slow. I mean, there's no way, in our opinion, that the fourth quarter of 24, when you look over the year over year compared to the third quarter of 24, GDP is going to be up, right? That year over year is going to come down. But it's our expectation that as we slow, we're still going to stay above trend. So we do think that the economy is going to weaken. And listen, we've all talked about and we've all been surprised at how long of a lag we've seen, given the fact that the Fed has been on hold for almost a year, which will be next month, but that will still come into play. So we do think it's going to weaken, but not be weak, because you still have fairly strong household balance sheets, fairly strong corporate balance sheets, and the consumer, while not as strong as it was, is still fairly resilient.
I want to hone in on your call about going into investment-grade corporates, high-quality corporates, especially at a time when spreads are already pretty narrow. Basically, the extra yield that investors are earning over benchmark rates, pretty low. They've been creeping higher. They're actually at the highest in investment grade going back to March, albeit very low, still under 1 percentage point in terms of extra yield. At what point do you have faith in corporations more than you do the full faith and credit of the United States? In other words, you don't expect that premium to widen. If anything, it will shrink over time as people look to yield, and any extra more than, say, that weakening in creditworthiness.
You know, look, I absolutely agree with you. There, you know, IG right now is not cheap by any stretch. And to your point, most of the yield is coming from the level of treasuries, not the spread that you're earning. But with that said, even if you look at the type of foreign demand that we've seen come into corporates, which has really been able to, you know, be a great tailwind to, you know, not have the extra supply that we've seen really widen spreads out. But, you know, we do think the demand will be there, but there's no question the corporate market really where the total return is going to come from is going to come from a bit of carry and some price appreciation. But that's just part of the picture in terms of high grade. We also think you should be in agency MBS, which we actually think is cheaper to IG corporates, and those things like treasuries. Where we don't want to be right now, and we talk about compressed risk premium, isn't really the lower quality sectors. And it's not that we think that there's going to be a catalyst, and if we saw some widening, we look at it as opportunistic, but you're really not being compensated for it. So while things like investment grade corporates are not on the cheap spectrum by any stretch, it is going to be steady carry. If you lock in that interest rate risk, you are going to have that price appreciation, in our opinion, going forward. And it's just one of the sectors in the diversified high quality with treasuries, IG corporates, agency MBS and munis.
Leslie Falcodio of UBS, thank you so much for being with us. And maybe other people agree with her, Danny, which is a reason why Hertz is having to pay up something like 13% in order to raise money in the debt market.
Yeah, exactly. People are willing to pay up. But again, just the supply has been really remarkable this week because it was pretty light last week. And the thinking was there was too much volatility in this market for corporate appetite to still be there. It has come back. So it is clear that the volatility is not an issue. And in that Hertz announcement, I mentioned this before, more than the bond sort of thing that they did, I thought was really interesting is that they said that they're seeking lower priced vehicles in their fleet, that they're noticing customers don't want to pay up anymore for the expensive cars. It's something we're seeing across companies, you know, the McDonald's $5 menu, that price fatigue is real.
And guess what they're not buying? Electric vehicles after that experience and the subsequent depreciating fleet at a faster pace. Coming up next hour, Amy Wu Silverman of RBC with some really interesting things to say about NVIDIA in particular. Sarah Senatore of Bank of America Securities, Veronica Clark of Citigroup, and Dana Peterson of the Conference Board on a day where basically markets are trying to find direction after a week of minor gains led by NVIDIA.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Growth is strong, that's great for all sorts of trades. If growth is weak, well, guess what? The Fed is going to step in and actually cut interest rates.
If we see inflation coming down, if we see the labor market continue to cool, they're going to go in September.
It's an inflection point for the labor market for sure, but it's also an inflection point for the inflation story as well.
What Fed speakers need to do is to double down on their commitment to inflation stability and targeting inflation.
They would be doing themselves a disservice, they'd be doing markets a disservice if they tried to be precise at a time when you can't be precise.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
I can't say let's get you to the weekend because it's trademarked and I'd have to pay royalties, but this is the last hour of the show ahead of the weekend, and I will just say this. We're going to be getting some data later this morning at around 9:45 a.m. Eastern, and traditionally this is data that hasn't necessarily moved the needle. In recent months, things are different because people, Danny, are looking for any sign of weakness that could confirm that maybe we're not just weakening, but actually heading toward a weak.
I think I called ISM's once tier 2 data on my show that I usually do an hour before this one. I heard John on this show actually call me out for that and be like, it's not tier 2 data, but it is, and we're, I think it is, and we are trading on it. I mean, we traded on housing starts yesterday. It is a very sensitive market because it is a data-dependent Fed, thus we have to be data-dependent too on literally every single piece.
Which really is the reason why I found what we got from France and from Europe more generally overnight really interesting. We're going to be getting the S&P Global Manufacturing and Services PMIs at 9:45 at a time where you are seeing just a slow rolling over. Again, it's not necessarily recessionary, but it definitely has been a weakening. How much is really political, as some people were saying in France, and how much is to a point that, Anne-Marie, you were talking about, a lack of ability to have visibility as a company? So then how much conviction can you have in making those big investments?
Well, and how many people have come on this program and said we're at an inflection point? So this is why data, even if it's tier 2, might matter, because it might give you clues of what's going on. What happened in Europe when you have this weakening of the manufacturing or the business sector, what they're coming out, the director of the survey saying is that anecdotal data, what that's telling you is that businesses at the moment see the political risk there and say, I'm just going to wait it out. Why would I get in now when I can maybe wait a month and have a little bit more clarity?
And the lack of clarity is one reason why people, in the absence of all of the clarity, had clarity around one thing, which was to buy NVIDIA. And we've been talking about that all week. Reached record highs, biggest company in the United States. It lost that title yesterday back to Microsoft, so only had it for about less than 24 hours. But Danny, it raises this question about how perilous or how fragile the market rally is at a time where it's been one stock powering about a third of all gains in the S&P so far this year. And people are starting to really question valuations here.
Yeah, yesterday was just the perfect example of what can go wrong, that you can just have not the majority of stocks, but the biggest stocks fall, the biggest stock being NVIDIA, and it brings down the whole market with it. I mean, Michael Hartnett in Bank of America, in his note today, talks about everybody feels like they're missing out, but on the same hand, they're really worried about concentration risk. But it doesn't matter. People have been piling into this thing, which again means once it turns, it's all the more painful because a lot of people are going to be left holding the bag.
Well, if you're looking for a dip to buy, maybe this counts as a dip. Today we're seeing about maybe 1 to 0.2% decline on the S&P, on the NASDAQ. You're just seeing it fluctuate around that 55.35 on the S&P. S&P. Euro weakening yet again. And this to me is interesting. 106.91, sub 107. Can we get down to Terry Wiseman's 105? 10-year yields also headed lower, almost 4 basis points lower now, 4.22%, as we await that key data, as in addition to some housing data at a time where people continually tell us don't expect prices to go down, don't expect affordability to get easier. Crude just down a touch, but still north of $80 a barrel, 81.15 on the NYMEX. Coming up this hour, RBC's Amy Wu Silverman on why she's calling the equity market a paddling duck. Bank of America's Sarah Senatori as the fast versus casual dining price war heats up about breadsticks and other things, the $5 Happy Meals. And Citi's Veronica Clark on our continued call for a September rate cut. Let's begin with the big issue. NVIDIA continuing to drive markets, the AI-driven rally losing a bit of steam, the chip giant giving up its recently won spot as the world's most valuable company to Microsoft. RBC's Amy Wu Silverman saying this. You know the scene in the Titanic where Rose is at the helm of the ship with her arms open? That's NVIDIA right now. Despite the massive bull run we have seen in NVIDIA stock, this has not been reflected in option sentiment. And this is a notable change to the first 3 to 4 months of the year where option sentiment did match the bullishness of NVIDIA stock. This implies that investors are no longer feeling the FOMO and the need for right tail leverage that we saw earlier. Amy joins us now. And Amy, this really speaks to what we've been seeing in the market, which is not the same kind of ebullience, all-in FOMO of this scene where she's just enjoying the air in her face. I mean, how much is this something that signals to you that NVIDIA's kind of run out of steam and how much it can just keep melting up in the FOMO trade?
Good morning. You know, look, when I look at NVIDIA, when I look at, the Mag 7, it really is telling because I think on the surface, everything looks fine, right? But when you kind of look at the option sentiment underneath, it's really a completely different story, Lisa, than it was the first few months of the year, where the bullish option sentiment really matched that right tail exuberance we saw. People had benchmark FOMO. They really had to jump in the pool because NVIDIA was so much of a weight of the benchmark. But you're actually seeing the opposite happen right now. So you're seeing that put skew, you're seeing that demand for hedging actually tick up in a name like NVIDIA. And again, that's not true for everything. So it's not this holistic move, but you are seeing it specifically in NVIDIA. And I do think underneath the surface, that sentiment is shifting a little bit.
This is fascinating at a time where, and this is something Anne-Marie pointed out, we hear inflection point from person after person after person throughout the morning. Are you seeing an inflection point in the way that people are arranging some of their hedges in terms of trying to hedge against downside risk in NVIDIA rather than, say, upside risk in the rest of the S&P 499 that haven't really caught up in the same way?
Yeah, if I had to characterize it, I would say we're sort of at a pre-inflection point in the sense that you see this right tail being sucked out of the market. That's very important, but you haven't really seen that left tail swing to all-time highs. We're nowhere near the expensiveness of levels we've seen in the past. So one thing I've been calling this summer is a do-nothing summer, and what I mean by that is for a lot of these stocks, like an NVIDIA, like an Apple, like a Meta that have done so well, something like call overwriting, where you're essentially saying, I'm going to sell a little bit this upside. Maybe I can use it to fund downside. Those are the compelling strategies for a summer where seasonally it's lower volatility, but I don't think we've gotten to the point where people are capitulating.
While you're saying the sentiment is declining in NVIDIA in the options market, it's actually rising in Apple. Why?
Yeah, so that's really striking to me because, again, if you had looked to March, which I would say was peak exuberance in NVIDIA, essentially the mirror opposite was happening in Apple. It was a lot of it was related to the China story. And I'd say, look, this is a tale of a paddling duck. The reason I keep going back to this analogy is everything looks calm on the surface. Everything looks great from a VIX headline level, from index volatility, but you do get these violent rotations, and often at a time where, look, when only 4 or 5 names are the massive contribution of return to the market, the fact that one is going one way and one is going the other way has actually become a diversifier in the market. I've had investors joke with me, why do I need a bond equity portfolio? I just need a Mag 7 versus everything else portfolio.
Amy, I mean, a lot of people this year had sort of decried that the options market is not broken, but fundamentally changed with the rise of zero-data expiry options. It's something we heard about so much to start this year, that these options that expire, again, the next day, they expire the same day, that they're gaining in popularity, and it's causing more volatility. I think JP Morgan's Marko Kolanovic even one time said that it would lead us to Volmageddon. I mean, what is the status of that? Because it's not like we've seen any huge volatility disruptions. In fact, the VIX has been incredibly calm all year. Is this no longer a threat, or is it something that's still simmering below the surface?
So I think it's really interesting, and I think one thing to bear in mind is zero data expiry options have been very popular for S&P, where it's accounted for almost half of all volume, I think even a little more at this point, but it's not impacting your stocks like an Apple, Nvidia, Meta. And so, one thing I talked about in the Volatility 2024 Outlook is that you have to look to the single stocks for the drama. Yes, headline volatility when you look at something like S&P is quite low, which is what VIX is based off of, but it's actually not true underneath the surface. So it's really a tale of two different option markets, which is why we think something like selling calls on single stock levels might be compelling, even if you think it's owning index volatility on the S&P level. So again, two different stories when you look at two different markets.
So Amy, before we let you go, the do nothing summer, let's talk about the contours of what that looks like for people who are saying, don't have to say it twice, I'm out of here. How much is this basically this idea that there isn't going to be much in terms of performance versus people not wanting to take any bold action ahead of what could be a pivot point, the pre-inflection point that you talk about?
So I like to go back to this stat, which is we look at the Sharpe ratios of all constituents of the S&P and the Russell. And the reason we do this is it's a good mechanical and quantitative way to say what's just our risk-adjusted return in the market. I have to tell you, across every single sector, it continues to decline, and it's been declining for the past 3 years that we have been tracking it, the only exception being energy. And so the question is, how much more room, how much more upside objectively are we seeing in this market? And if that is the case, essentially from an asymmetric point of view, doesn't it make sense to hedge? One. And second, any exogenous risk, I think, can kind of shake us out of the doldrums. And that's always been true, but the cost of protecting against those exogenous risks are very low.
So just to clarify, Amy, is a do-nothing summer also a summer of complacency?
Very possibly, yes. But, it's when you're a derivative strategist and you've been the girl who's cried wolf before on these exogenous risks and they haven't panned out, you do have to acknowledge that there is a reason why realized volatility is low. But that is not to say that the cost of protection is not at historic lows. It is. It's just a question of we don't know the timing of exogenous risks. And that has always been the problem, is you don't know when the music stops.
Amy Silverman of RBC, thank you so much for being with us. Always illuminating to hear about that, the idea of the risk-reward getting thinner and thinner. All of this seems to be pointing to the risks are mounting, and yet if you've been calling wolf all of these years, you're not going to want to be on the wrong side of a trade that's turned out to be more FOMO than, say, hide under a mattress.
Yeah, exactly. I mean, this is the thing with options, is you can be right, you can want hedges, and it just gets more and more expensive to hold them because you do have that deterioration. It gets really, really tricky, again, to Amy's point, to hedge some of this stuff. You can say it's as cheap as it can ever be, and I want to be ready for all of these shocks, but you're going to lose so much money as you prepare to do so.
Just get zero data expiration, and you'll be fine. Let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief. That wasn't an endorsement, with Yahira Hackis. Yahira.
Hi, Lisa. Donald Trump's campaign outraising President Joe Biden's for the second straight month. Trump's campaign saying it raised a jaw-dropping $141 million in May amid a fundraising boom after his historic conviction. Meanwhile, the Biden campaign in May raised $85 million, the troubling development for Biden coming just ahead of the candidate's first presidential debate on Thursday. Wall Street's so-called triple witching could provide traders with some short-term market swings today. The triple witching will see around $5.5 trillion worth of options tied to indexes, stocks, and ETFs fall off the board, according to an estimate from options platform Spot Gamma. As the contracts expire, investors will adjust their positions, adding a burst of volume capable of swinging individual holdings. And shares of Spirit AeroSystems are rising after a report from Reuters said Boeing is close to a deal to buy back the aircraft parts supplier. The latest development coming after substantial progress was made in talks over the work Spirit does for Boeing's rival Airbus. Boeing initiated talks earlier this year to buy back Spirit, but the talks hit a snag over the work for Airbus. The report adding the exact timing of the deal is unclear, but it could come within days or weeks. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the Morning Call's Bank of America restaurant analyst Sarah Senatore as McDonald's escalates a fast food price war. That's coming up next.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Still talking about Mbappe's face mask. Right now we're looking at a market trying to find direction, indicated a little bit lower as people reassess just how much more room there is to rally, deepening those losses on the S&P, down now 0.2%. You could see that also in the NASDAQ as NVIDIA doesn't come to the rescue as it has so many times before. Time now for the morning calls. First up, Bernstein raising its price target on Apple to $240, maintaining an outperform rating. The firm saying it is, quote, increasingly convinced that Apple will be an AI beneficiary, even if those benefits take longer to materialize than some bulls appear to believe. Next up, Oppenheimer upgrading Nike to outperform. The analyst noting that the sportswear giant is, quote, on the mend after several tough quarters. Oppenheimer reinstating Nike as a top mega cap pick. And finally, Bank of America Securities maintaining a neutral rating and a $288 price target on McDonald's. Analyst Sarah Senator saying the upcoming rollout of its $5 combo, quote, addresses the lack of a national value menu, but it isn't enough to overcome the chain's cumulative price increases compared to Wendy's and Burger King. Sarah joins us now. Sarah, can you just set the stage about how much more expensive McDonald's items are than, say, they have been in the past? The idea that they're not thought of as value meals in the same kind of way that they once were.
Sure. I think, as you alluded to, what we have seen is that every year McDonald's has increased the average menu price by a little bit more than what we had seen from some of its competitors, at least for the last 3 years. So pricing was very competitive in terms of just increasing prices across the board, maybe 1 or 2% every year. And then we saw a real spike of inflation hit in 2021, 2022. Most restaurants responded with higher prices, but McDonald's pricing led its competitors typically by 2-3 points per year from 2022 to 2023. And now, again, we've seen that in the first quarter where the gap is maybe even actually a little bit wider. We think McDonald's increases prices high single digits in the first quarter versus in that 3 or 4% range for its biggest national burger competitors.
So this is sort of a compelling state of play. It raises this issue of whether what we're seeing right now with price cuts or a new value meal for $5 is McDonald's catering to a increasingly price-sensitive consumer, or if it's just they're losing share to other fast food companies that have done maybe a less inflationary job with some of their menus.
I think the answer is both. So we certainly have seen the consumer has been more selective about where they're going out to eat. We see that particularly with lower income households where there's just been more cumulative pressure from inflation, for example, on real spending power. And so what we know is that as inflation broadly across the economy has slowed, consumers are more cognizant of which companies, whether it's a restaurant or someplace else, have taken more price or taken price increases faster than others. And so I think we are seeing more selectivity, and some of those consumers are going, not just to direct burger competitors, but elsewhere too. I mean, we've heard, for example, from Chipotle that they're seeing strength in the lower income customer. We've even heard from, Texas Roadhouse that they think that they've seen some trade up into casual dining, perhaps from other segments, because their value proposition is so strong.
It's not even just into some of these different value propositions, Sarah. We saw Kroger, they had their earnings yesterday, and they talked about, for the first time in some time, they've seen a real growth in what they call the budget customer. How much are just overall eating out volumes down because people say, hey, we don't have the money. Sure, we missed out on it at COVID, but now wallets are pinched and we're just going to go to the grocery store.
Well, I think basically what you just described is to some extent, first of all, it's sort of the status quo, which is to say consumers that are under budget pressure typically eat more at home. What we saw during COVID is actually sort of what I'll characterize as pent up demand, or kind of a spending with abandon. So what we saw, I think, for the last 2 or 3 years was quite different from normal, which is to say we saw consumers actually trading up. So we heard yesterday from Darden about how some lower income households were dining at their fine dining establishments, Capitol Grill, Ruth's Chris, and now are returning more to normal patterns. So I think, to your point, year over year, we are seeing declines in traffic, particularly among lower income households. But we're back to more of a normal environment where people are allocating their budgets more like they typically would. Still, the long-term trend is to eat out more over time. But when consumers are under pressure, we do see a little bit more dining at home.
So it's maybe normalization, Sarah. Are you seeing any signs that it might be more than that?
To date, no. I mean, as we have seen, again, is sort of that mix. When you listen to Darden, they talk about the mix of households. They're pretty much back to where they were pre-COVID. So that mix of lower, middle, upper income households, depending on their concept, the price point, finally back to where things were pre-COVID. So it looks, to use your words, normalization, as opposed to the consumer is under intense pressure, or we're falling off a cliff here. I think there's no room for panic just yet.
How much are labor costs weighing on some of these companies, especially seeing what we saw out of California when it comes to wages?
California is certainly a unique circumstance. Wage inflation was very high during the couple of years after COVID. The labor market was quite tight, particularly for restaurants. Again, late 2021, early 2022, we were seeing low double-digit, mid-teens wage inflation across the board. Now it's, again, I'll reuse the word normalization, because that applies here too. We're hearing from most restaurants that outside of California, wage inflation is more in that sort of 3, 4, 5%, the mid-single-digit range, which is precisely where it was before 2021, before the reopening really drove wages up dramatically. The exception, as you say, is California, where we saw the $20 minimum wage really kind of overnight raise wages, at least for the companies to which it applied, by 17, 20%. Now, most of them were paying more than minimum wage before the minimum wage went to $20, but you still want to maintain that gap between those who are making entry-level wages and those who are more senior and more tenured. So you want to avoid wage compression, so all wages do come up to some extent, even if you're already paying above minimum wage.
I don't know if you can talk about this, but we'd love to get your take on what happened with McDonald's and these viral, AI mishaps, and the fact that they had to pull this program. Do you think more companies are going to maybe pause before they start using AI because what we saw take place in McDonald's?
Well, I think technology always brings with it some hiccups, some stumbling blocks. I would say even when McDonald's rolled out Experience of the Future, which is kiosk ordering, you saw some initial challenges, right? It wasn't totally smooth. People had to learn how to use the kiosk. In fact, McDonald's had kiosk ambassadors in their restaurants when they were reopening with them. So in fact, initially, you had more labor, not less, because you had to introduce customers to the idea of using, what was effectively a gigantic iPad to place your order. And I think, we shouldn't be too surprised that when new technology rolls out, it takes operators and consumers time to learn how to use it. And of course, it takes time for the technology to be perfected. And so this is, I don't think, this is not a new dynamic in place. The social media coverage may be new, but it's always the case that there are some initial bumps in the road when you're working with new technology.
Well, what is it, the avocado or something from Chipotle that I thought sounded really promising? Yeah, avocado.
Yeah,
I thought that was promising. I mean, honestly, that was something that was cut in half. I should endorse it at home. No.
I mean, if you eat a lot of guacamole, yeah, for sure.
Not stop staple. Sarah Senatore, thank you so much. I really appreciate your time. Sarah Senatore of Bank of America there on the fast food. I mean, you raised a question, although Danny did, Anne-Marie mentioned that maybe bacon on a McFlurry is a positive thing, but
or
the real
hundreds of dollars
questions.
of chicken nuggets instead of the order you wanted, which was probably maybe a dozen or so.
I don't know, the world is littered with these examples. Like my absolute favorite one is the Amazon Go stores where you go in and it says, oh, AI is going to analyze what you take out. There was a story that it turns out that a lot of the interactions had just been thousands of workers in India watching you through cameras, and Amazon was telling people it was AI.
That actually makes a lot more sense than some of the things that I've seen. I mean, you wonder how much they can actually get the efficiency. Also, the idea of ordering on a big iPad. That, to me, is so deeply frustrating. When you go somewhere and you're like, can I just give you my order? No, you can't. Go there. Do it here. Use the QBR to be able to get the menu, to be able to order online. And then, it's just all these hiccups.
And I'm sorry, maybe this is really germophobic of me, but it's kind of gross. Like, people have been there all day. Kids are poking around at the menu, and you got to touch it and then use your hands to eat a burger.
Hope you're enjoying your breakfast right now. Coming up, Citi's Veronica Clark and Dana Peterson of the Conference Board will be joining us as we tease ahead to what we get with S&P Global data on manufacturing and services. Right now in markets, a bit softer as people lose luster for NVIDIA.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Heading into the close of the week with a bit of softness across the board, led down actually by the NASDAQ, a reversal of fates after, frankly, that had led the way for quite a while. S&P futures and NASDAQ futures both down 0.2%. The Russell 2000 finally outperforming by not losing anything. That is sort of the state of play at a time where NVIDIA had been leading the charge, but doesn't seem to be doing so at the moment. Right now in the bond space, you are seeing a bit of a bid into bonds. Dave, I gotta say, this morning to me it really highlighted how much people are shifting from Leslie Falconio to Katie Kaminsky. This idea that maybe we're at some sort of tipping point where weakness that we see in the economic data signals something else that's perhaps a little bit more protracted.
Yeah, it feels like there's finally some momentum to this bond market. I guess the tricky thing of it is, even if the trend is for yields to come in, is that there's still lots of potential for volatility. Sure, we've come more in line with the Fed, and that kind of helps with volatility, but are these opportunities for inflation to spike, whether it be supply disruptions, whether it be the price of oil? It doesn't mean it's an easy road ahead.
Whether it's the price of housing, and this is something we've been talking about significantly, given the fact that there's so much pent-up demand to buy, that any kind of decline in mortgage levels could potentially lead to that type of increase in activity. Meanwhile, what you are seeing in the Euro space, a bit of softness after people reassess just how much more political risk there could be. 106.91. Really an issue here is how much is priced in and how much has yet to be. Anne-Marie, you mentioned earlier that quote from someone saying this is the new normal. We saw spreads widen out even further between French bond yields and German bond yields this morning. And some people are saying, you know, this is just waking up political risk in the sovereign debt markets in a way that it hasn't been since 2012.
Zurich Insurance, they're saying basically they're not going to go back to levels once those snap elections were called, once this risk was already introduced. Now this is, in France at least, the new normal. But a lot of people are saying, take advantage of this moment then. They don't think it's going to be as bad as some people are suggesting. So they say, now's the time to position yourself.
All right, well, under surveillance this morning, more turbulence for major airlines. United flight returning to Connecticut Airport after losing a part of a liner from inside an engine cover. The FAA saying it will investigate the incident. United's safety procedures are already under regulatory scrutiny. Meanwhile, unionized American Airlines flight attendants are threatening to strike. Their latest round of talks with the company concluding without an agreement on a new contract. We're talking about all of these airplane stories, and we talk about it with respect to the exact airlines, some of the troubles that they've had. But Emery, it's kind of time where we see ongoing demand to fly. It is pretty consistent. We see record potential travels for the July 4th weekend. So which is it? Is this basically just people looking to capitalize on the strength by getting their due? Is it airlines that have mismanaged their finances and don't have older planes? Or is this really kind of a shifting point that we should be focused on?
Well, we've been here before with American Airlines. Last month, the union was talking about potentially going on strike. They went back to the negotiating table. But Lisa, you bring up a great point. The leverage they have right now on the cusp of a massive summer traveling season. Can you imagine 28,000 of these airline workers not running and not working, these flight attendants for American Airlines? That means those flights likely are going to be grounded.
It really feels like it's going to be the summer of discontent. It's going to be insanely hot. We all want to go somewhere, and we're going to have to wait forever at a line. I mean, that all of it sounds not great.
Unless you have Clear and TSA,
okay,
and that's the pro move.
I think she's in the pocket of Big Clear. I'm a little bit concerned.
Well, we'll do some investigating after the show. Meanwhile, presidential fundraising figures for May showing Donald Trump outraising Joe Biden for a second straight month. Biden picking up $85 million, well short of the $141 million donated to Trump's campaign. Amy, how much is this just catch up? Basically, Trump hasn't gotten the donations from big business, from the millionaires and billionaires who previously might have gravitated toward him, versus, say, a greater acceptance by more mainstream donors.
Every single day you see a new story of someone else that's coming out who prior had said they were distancing themselves from the former president, especially after January 6th, but then decided they actually are going to come on board now. Biden has been way ahead of Trump when it comes to building up that war chest, and now Trump is playing catch up. One thing that is interesting, though, even though we did see these monthly figures, Trump is definitely outpacing Biden for the monthly figures. Biden has a lot of money on hand, and Trump has not said actually how much he has in the bank. But certainly right now, the money's rolling in for him.
All right. Meanwhile, former St. Louis Fed President Jim Bullard saying the latest CPI print puts a September rate cut in play. Bullard now expecting 2 cuts this year, in line with market pricing, but above Fed officials' projection for just 1. Just before we get to our guests, Danny, how much are we even listening to Fed speak at this point? How instructive can it be, given that ultimately everyone just believes that we are ultimately squarely in the data-dependent zone?
How much can we listen to it when they're, I mean, not to be really cruel, but not really saying anything? The only thing we're hearing from them is we gotta wait. I mean, what do you do with that? I mean, you could be really harsh. Robert Zoellick, the former World Bank president, wrote a really stinging critique in the FT, basically saying, look at Powell, look at Lagarde. They're not economists. They are just technocrats. They're not in a position where they can really lead us. Instead, they have to rely on forecasts that the central bank has, and those haven't been working out. So we're left with these central bankers that say data dependence, and he calls it a term that means central bankers don't know what to do.
Yeah, so maybe we'll start to shift to scenario analysis. Right now joining us, Citigroup's Veronica Clark and Dana Peterson of the Conference Board. Veronica, I want to start with you. It seems like the world is shifting your way in terms of looking for more economic weakness and not necessarily celebrating the resilience in the same kind of way. Do you think that maybe there is this tipping point in the economy that's becoming more clear, or do you think that people are just realizing that maybe they got over their skis with betting on the soft landing?
Yeah, it was only a couple months ago where we were, the narrative was re-acceleration even, but I think the data now have more clearly slowed, and I don't have trouble convincing people that the economy is slowing like I did a couple months ago. But yeah, it does feel like to us that this has been a very gradual slowing, how cycles usually begin, and we might now be at that tipping point where you enter this non-linear weakening where you really do get layoffs that build on each other, and that would be obviously a much worse economic backdrop.
Dana, do you see this tipping point from your vantage point as well?
Well, for a long time, we have been predicting a slowing in the economy. In fact, we had a recession call for a long time. Now we think that the second and third quarters are going to be weak, growth probably between 0 and 1%. Consumers leading that decline. But the thing is that consumer spending could even be wiped out, but not really have a recession. Or even a bad recession, because most consumers are working. The labor market is doing quite well, wages are elevated, and businesses, according to our CEO confidence survey, are not looking to let go of workers. That is a key factor that's going to keep the unemployment rate low, even if we do see some layoffs on the margins.
Okay, well, this looks like an area that perhaps, Dana, you and Veronica disagree. So let me press you on this. Dana says that you could start to see what we typically see in a cycle, that some layoffs turn nonlinear and it picks up with some speed. Why would this time be different?
Well, this time is different because of labor shortages. And the reason why we have labor shortages is because of demographics. It's never been the case that we've had 10,000 people retiring per day. Those are the baby boomers. And so that's why businesses are saying, even though for at least a year and a half they're expecting a recession to happen, they were not interested in letting go of their employees for 2 reasons. Yes, of course, labor shortages and people retiring, but also because they had the sting during the pandemic of trying to find qualified workers and raising wages to do that. So you don't want to repeat that, even if you think there's going to be a slowdown. And this is a structural change in the economy that we have not seen.
Not to do this to you, Veronica, but why could Dana be wrong?
Yeah, no, I mean, I don't disagree that, we have experienced labor shortages over the last couple of years that might be leading, to employers holding on to workers for longer. You don't want to lay people off and have to hire them back at a higher rate. But that is, I think, still a precarious position if you've been holding on for workers for too long. And then all of a sudden you do have to let people go. That could mean you're letting even more people go. I don't think that necessarily prevents the layoffs. So.
Dana, also, I have a question about what is going on in the labor market, because we had Barclays come on with a report, and they were talking about how pretty much we've had this insane surge of immigration that we're seeing so many jobs being filled by. So where exactly is the shortage?
Well, when you think about immigration, a lot of it's catch up. So remember during the pandemic, we had travel bans. And so that meant also if you were an immigrant or, whether you're an H-1B person, you could not enter. So a lot of it was just getting back to the levels that we saw in terms of immigration right before the pandemic. But the shortages are definitely happening, especially in leisure and hospitality, healthcare and social assistance, not residential construction, and also government. And if you notice, many of these jobs, you have to physically show up for work. And so companies that we speak to, CEOs of the Fortune 500 firms in the US, have been saying, look, we can't find qualified workers for these jobs that are necessarily dirty or uncomfortable. You have to deal with the public, or there's no flexibility in terms of hybrid work.
Veronica, when it comes to immigration, how do you view it as basically putting a cap on inflation? Have we reached the point where pretty much that story is over and starting to normalize?
Yeah, I mean, I definitely think, it's been helping to loosen the supply side of the labor market, of course, more workers. So it is helpful for inflation on that front. But immigration is a boost to both supply and demand. I mean, those are people who are going to, buy goods and need housing. So it's not so clear what that does to inflation. It is probably overall a disinflationary force, but not necessarily a big one.
Let's dig into this. And I'm glad that, Emery, that you brought up the Mark Giannone report from Barclays. He was talking about how, honestly, it's counted for about 3/4 of all job creation so far in recent years, the immigration flows. To me, this is sort of shocking. And I'd love both of your takes. Veronica, I want to start with you, this idea of, is this the right kind of job creation that's going to really create a sustainably and stronger economy versus filling in gaps and doing it on the cheap in a way that maybe makes people understand why, even though we have a good labor market on the surface, people seem so dissatisfied?
Yeah, I mean, I don't think the immigration story is necessarily one that's going to last with the strength that we've experienced the last couple of years. I don't think we're going to have such strong immigration maybe 5 years from now. And it's not so clear, that these workers have been hired at lower wages. We still see average hourly earnings something like 4% year on year. So there hasn't been this big disinflation in wages. But yeah, it is probably partly adding to that.
Well, but this also, Dana, something we were talking about with Mark Giannone of Barclays, this idea of how much can we really understand the numbers that we're seeing for the labor market as being strong if they are very different than what they've been in the past, if the jobs being added are new people coming to the country and don't account for job mobility, also don't account for how much this economy has grown and how many more people are in the labor force when you start to talk about just absolute numbers. How much is the view that we have of the labor market overly rosy based on just historical comps that are no longer valid?
Well, laborers are laborers. It doesn't matter if they're foreign born or they're domestically born. The point is that we don't have enough people in the labor market right now. Look at the labor force participation rate overall. It has not returned to the pre-pandemic level. Why is that? Well, if you break it out, looking at people who are prime age, 16 to 64, yes, that participation rate has recovered, but people 65 and older has not. There are people exiting the labor market. So immigration certainly is going to be, continues to be, and will be an important solution to addressing the fact that we're losing workers hand over foot to retirement, but it's also getting those domestic workers out. And certainly when you look at the wages, the wage gains that we're seeing, they're in goods. So those are the types of jobs where many people who are immigrants might gravitate to, and those wages are still rising very aggressively. And even among services, wages growth has slowed, but it's still particularly elevated relative to the range that we saw pre-pandemic. So I don't see an issue with the types of jobs that people are taking, whether they're foreign-born or domestically born. The point is that they're working, their wages are elevated, they're getting income, and as Veronica said, these people are going to be consuming and spending. They're desiring the same things that domestic workers are.
And it's a structural thing you're talking about, Dana. You said that there still aren't enough people to fill all of the jobs. So when we're talking about this world of trying to bring inflation down, waiting to see if there are cracks in the labor market, is it waiting for Godot? Do we need to get used to something a little bit more uncomfortable because there are still persistent supply issues?
Well, really, when I look at the drivers of inflation, it's certainly labor supply, and that's beating up wages, and that's flowing through to services, excluding housing, and certainly excluding insurance premiums. But the thing is that that's probably not going to wait. That's something that the Fed is going to have very difficult time resisting because, again, it's a supply issue and the Fed is good at addressing demand issues. Now, where we're going to get a lot of traction on inflation coming down over the next 12 months is from housing. And if you look at the Case-Shiller Home Price Index and you lag that by about 18 months, that'll tell you exactly where OER is going. But the other thing that's going to be beating up inflation is insurance. So certainly insurance costs for autos and also for housing. Very different reasons, but the thing is that we don't know when those rises are going to end. So the Fed is still going to be challenged in terms of getting inflation back to the 2% target sustainably.
Dana Peterson and Veronica Clark with us as we look back on some of the data that we've gotten recently. Coming up, and I'm glad that, Dana, you brought up home sales and home values in terms of just the inflation that we expect to see. We do get existing home sales later today. Next week, we do get the latest read on CoreLogic home prices. Veronica, how much do you believe what we've been hearing from the likes of Jonathan Miller and others who say, at this point, if the Fed cuts rates, that's going to only reignite a housing market that's just waiting for any catalyst for people to have a more affordable entry point?
Yeah, it's definitely something we're watching. Certainly anecdotally, it feels like maybe you could get some buyers coming back. But we did see, even with mortgage rates, above 7% last year, there was this surprising resilient demand for housing in 2023. There was resilient demand for everything, but people couldn't buy homes because, people were not willing to sell. But we've actually in the last, 6 or 7 months seen listings of homes come up. They're above levels of the last 2 years, and there's not demand now. So it does feel like that resilient consumer is waning everywhere.
I also think this question of prices that Jonathan Miller also talked about is fascinating. Not just do people come back, but what happens to pricing of homes. Could we be in a scenario that he thinks will happen that kind of ironically the Fed cuts, but instead housing prices go up because demand comes back?
Yeah, it's not so clear. I mean, we have seen softer demand in the last 6 months or so, and that has been accompanied with softer prices. We've not seen the very strong, exceptionally strong prices of the last couple years in the last 6 months. So I think in the near term, at least, this is still a soft demand story, and so there's not quite that upward pressure on prices. But longer term, we are somewhat structurally short housing. Obviously, new construction will be pulling back. You're going to stay short housing. Yeah, that could put longer term pressure on prices.
Dana, when it comes to the American consumer, you talk about how they're also trading down in types of services they purchase. What kind of cracks are you seeing in the U.S. consumer?
Sure, absolutely. Well, let's just start with the fundamentals. While most consumers are working, that excess savings from the stimulus is gone. Also, many consumers are financing their expenditures with debt. And so all that's really coming home to roost. And so what consumers are doing is they're not buying goods. We saw that goods spending slowed at the end of last year. It was negative in GDP growth. And also when we look at retail sales so far in the second quarter, they're signaling another downswing in terms of goods spending. When it comes to services, consumers are still interested in going on vacation. However, they are trading down in the types of services. So for example, instead of going to the movies, which might cost them $100 for a family of 4, they're going to stay home and stream. And also consumers are looking at spending on services that are necessities. For example, healthcare and insurance premiums for your cars, but certainly not those highly discretionary types of services.
Dana, just to put this all together, what are you looking for to understand whether this is sort of a welcome softening and disinflation versus something that does have more pernicious legs?
Well, this is all part of the Fed's plan, right? This is basic monetary economic theory. You slow demand, which helps reduce inflation. That's what the Fed's doing. The challenge is that the Fed has all these other supply side elements that are leaning against what they want to do. Again, going back to labor shortages, which is a supply issue, raising wages. But this is all part of the program, making sure that consumers pull back on spending. That also includes home purchases. And certainly if you're not buying a house, you're not buying all the items that would go along with it. So this is good. And the thing is that the Fed is probably pleased with what's happening because at the same time, most people are working. You don't have massive layoffs. And indeed, we do think the unemployment rate's going to tick up, but maybe we'll land at 4.2%. That's well below the natural rate of unemployment, and that's still a really low unemployment rate. So if we have this perfect scenario of weaker consumer demand, weaker demand for housing, but also most people working and inflation slowing, that suggests that the Fed can go ahead and start cutting interest rates probably by the end of this year.
Dana Peterson, Veronica Clark, both of you, thank you so much for being with us as we get you set up for the weekend into the week ahead. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Move over NVIDIA. Microsoft is retaking the title of the world's most valuable public company. AI chip maker NVIDIA losing the crown after slumping over 3.5% in yesterday's trading and losing over $100 billion in market value. The stock is down again this morning. And in a filing with the SEC, it was revealed NVIDIA CEO Jensen Huang sold a fraction of his stake in the company for just under $32 million. Shares of CarMax are higher in the pre-market, the company reporting stronger than expected first quarter profit. That overshadowing a revenue drop. Retail unit sales decreased 3.1%, and the average used vehicle price also dropped around 3%. CarMax said vehicle affordability challenges continue to impact sales, with ongoing headwinds expected due to inflation, higher interest rates, and tightening lending standards. And New Jersey Transit says rail service has been suspended again for trains going in and out of New York's Penn Station. The operator saying unspecified issues with overhead wires owned by Amtrak were causing the disruption. This is the third time this week that local commuters have faced delays. Amtrak also says services between New York and Philadelphia will be on a delayed or modified schedule due to a disabled commuter train. That's your Bloomberg Brief. Lisa?
Messy and hot. Yahira, wonderful as always. Thank you so much for those updates and throughout the morning. Up next, setting you up for the day and week ahead, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Counting you down to the opening bell, here is the trading diary for the week ahead. S&P Global PMI data coming out at 9:45 a.m. and then existing home sales at 10 o'clock, which should be interesting given all the discussion we've had throughout the week on that. Monday, the Fed's Mary Daly and Chris Waller speaking. Tuesday, consumer confidence. Wednesday, new home sales. And Thursday, durable goods, plus another round of jobless claims. So, honestly, to me, when I take a look at what we heard from today, a lot of it was kind of this tipping point, inflection point that people aren't willing to sort of lean into. Danny, a lot of it was kind of this tipping point, inflection point that people aren't willing to sort of lean into. Danny, what's your final takeaway?
I think that, but specifically for the consumer. I mean, we had the retail sales data this week that I think showed some more weakness than some folks were expecting, but also what we're hearing from companies. I mean, Dana Peterson said it there, that instead of going to the movies, people are staying at home and streaming. We heard it in Kroger's earnings yesterday, that budget shoppers are coming to them for the first time in a long time, and restaurants we've also heard from too, saying that they're getting less foot traffic. This idea that it was a PTSD of consumers who were locked up in COVID and they're coming out and they're revenge shopping, and that would last forever because we were so scarred by COVID. I think this week has really laid bare the truth that as soon as you're worried about prices, that goes away.
Well, at McDonald's, for example, coming out with a $5 meal. Starbucks also, actually, a Wall Street Journal story coming out today talking about half price. This coming out, 50% off a drink. It's on. Keep checking the app all summer long for the deals heading your way. That coming after a real weak period in terms of sales, especially given some of the concern people have.
People have concerns about inflation. Shows up in the polls every single day, which is why people aren't going out and spending big on, say, all these lavender lattes and Starbucks having to drop their prices. But that's why I'm interested in the politics going into the weekend, because it feels like it's the final calm of a weekend before the storm. The debate takes place on Thursday, and Terry Haynes said earlier to us this week that this is going to be both candidates trying to frame the next few months before November 5th.
So what are you looking for with the debates?
Well, let's go back to what Greg Valliere said. He said that Trump, what Republicans are saying in private, is that his overconfidence is at too much of a risk. Does he come out too angry, too boisterous potentially? And then for Biden, this is Greg Valliere's point, does he carry the debate with a lot of excitement and energy for the entire 90 minutes? And Greg Valliere said this, his words, not mine: if Biden shows that he's clearly in decline, speculation will begin immediately about replacing him on the ticket. That's a major risk.
And that's something that we haven't heard a lot of. Will that gain some discussion as the week progresses? Coming up on Monday, we've got RBC's Lori Calvasina, KBW CEO Tom Michaud, BlackRock's Amanda Lynham, and Stephanie Roth from Wolf Research. We're going to be looking at housing prices next week. We're going to be looking at consumer confidence. We're going to be looking at some personal spending data. Right now, you can see the S&P claw back a bit of the losses from earlier, but still down about 0.1% as yields go lower. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Katie Greifeld. Futures taking a bit of a breather on this triple witching Friday. The countdown to the open starts right now. Coming up, it's triple witching. Traders brace for volatility as $5.5 trillion worth of options set to expire. Business activity loses momentum in Europe on French election fears. U.S. PMI numbers out later this hour, and expensive markets stay expensive. We'll speak to the biggest bull on the street, Julian Emmanuel, about why he raised his year-end price target. We begin with the big issue, the AI-driven stock rally taking a breather.
I think markets are a bit priced to perfection, if I may say, so all this Goldilocks scenario. But as long as we get the earnings in place where expectations, I think, are quite high, I think that's sustainable. But if there is some disappointment on the earnings, then of course there could be a kind of consolidation in the market.
Joining us now is Young-Yu Ma, BMO Wealth Management Chief Investment Officer. And you write in your notes that May's CPI report, it was a psychology shifting reading. Describe to me what you meant by that.
Yeah, it's great to be here. Thanks. Well, we think that May CPI report, where the headline CPI came in at 0% increase on the month, is really going to get people's attention and has gotten people's attention and gets the idea in mind that we are resuming this downtrend in inflation. And we're seeing that not just in the U.S., we're seeing that globally as well. And we think that's what's helping to prop up the market and support this next leg higher that we think will happen over the summer.
Well, tell me why that matters, because you think about Fed rate cut pricing, for example, it's been all over the place this year. So when you think about inflation to cut pricing to the actual stock market, does this market actually need rate cuts at this juncture?
That's a great question. The market has actually shown us that it does not need rate cuts. The market has done surprisingly and even amazingly well this year in aggregate without any rate cuts happening so far, and with the prospect of rate cuts has been kept getting pushed out further and further. So we think what actually matters most is the trajectory of inflation and that longer term consideration of where inflation is going to fall, where rates might ultimately fall, whether we get a rate cut in September, December, one rate cut, two rate cuts. We think that matters quite little for the markets, but this downward trajectory of inflation, resuming that path, we think that's what's going to be most important and what the market is going to key off in these summer months.
Well, let's talk a little bit more about the trajectory of inflation and a slew of Fed speak in the last few days. And of course, even more eco data on deck. Mike McKee, Bloomberg Chief Economics and Policy Correspondent, joins me now. And I want to highlight Austin Goolsbee saying that the Fed can cut with more inflation reports like what we saw in May. It really seems like May is the blueprint here.
May is the blueprint, and that's what pretty much everybody has been saying from the Fed this week. We had 10 voting, well, not 10 voting members, but 10 members talking about the economy. A couple others spoke on other topics. And basically what they said was what everybody has been saying, that if we get more reports like we got from CPI and what they're expecting from PCE, then they may be able to start thinking about cutting. There are some trades out there for July, but that seems still rather far-fetched given the Fed speak we saw this week. So maybe September is what to look for when we get the PCE report next Friday and then CPI in the middle of July. Things to keep an eye on. Meanwhile, today, there's not a lot to trade on, but we do get the S&P global PMIs for the United States. And here's what happened in Europe. Almost every single one of them went down. And it wasn't too long ago, just last month, that we had a bad PMI report on manufacturing, and it set the markets lower. So it's something to keep an eye on. That's at 9:45. I'll be back with those numbers for you. And then at the top of the 10 o'clock hour, Katie will be giving you the housing numbers for existing home sales. And that's an interesting number because while the markets have priced the fact that nothing's happening, when you look at what is not happening, it's kind of bad news for the economy overall. This is non-seasonally adjusted and seasonally adjusted sales, existing home sales. And look what happens. This is the time period when we are supposed to see the white line going up, which is the seasonally adjusted sales, because this is the peak of the spring selling season, and it's not happening. And so if that doesn't change, we're still going to get deeper into this housing hole the U.S. has.
Well, Mike, I know I'm talking to you in 40 minutes' time, but before I let you go, something I've been thinking about this week after what we saw from the Swiss National Bank, how it was kind of a coin flip going into the decision, and of course we ended up with a surprise rate cut from the SNB. When it's time for the Fed to cut, I just feel like we'll know that they're going to tell us in pretty certain terms when that's actually coming.
Oh, sure. They will start making it plain. We've got a Fed meeting at the end of July. We have the Fed Chairman Jay Powell testifying in mid-July, and then we've got the Jackson Hole Conference at the end of August. So if they're looking at September, many opportunities for the big guy to give us some hints toward that. And of course, the rest of them will be speaking as well. They don't like to surprise like the Swiss do. So the markets will be volatile, but we'll get advance word from the Fed.
Yeah, plenty of opportunities to set the table for that first rate cut. Mike McKee, we'll see you in just a little bit. Let's get back to Young Yu Ma of BMO Wealth Management. And as you were saying, it's the inflation trajectory that matters more than the rate cutting trajectory. And talk to me about why that is. When you think about the psychology of the C-suite, how does falling inflation actually work its way into the stock market?
Well, in a few ways. One thing is that stocks are long-lived assets and very long duration assets. So if we're actually looking at what's a fair value to pay for stocks and what's reasonable, investors are rationally going to be looking at a longer term trajectory and where the ultimate level of interest rates are going to end up, not so much where they're going to end up at the end of the year. If you talk about the C-suite, I do think that the C-suite just wants to see that trajectory to be comfortable with more spending plans, greater expansion, and to be confident that the soft landing has actually happened. And once that confidence really sets in, we think companies are going to turn more toward growth mode. They've been in cautionary mode for quite some time. And once they turn more toward growth mode, there's going to be an additional jolt of spending in the economy that's going to be helpful for overall growth.
So what do you do until that point? Do you just buy tech, for example, where you have companies spending billions and billions, if not trillions of dollars on things such as AI?
Well, that's certainly where a lot of the money's been flowing. It's been a very much a one-way trade so far. We do think as inflation continues to moderate and the Fed does start to get a rate-cutting campaign by the end of the year, we do expect the market to broaden out. But really just staying invested here, not being shaken out of the market, especially as we start to, in the third quarter, approach the election season, which could inject its own dose of volatility, really just focusing on the underlying fundamentals, which between earnings growth, which look to be accelerating, between stable underlying economics, we think there's a lot of reason to be optimistic here still, despite the run-up that we've had in tech. And we think we're in the relatively early innings of the AI boom. So even though there's been a big rush in the space, we don't think we're near this being played out.
And where do you also see opportunity? I mean, we talk about tech all the time. We could talk for the next hour about tech if we needed to, but outside of just that sector, I mean, where are you looking right now?
Well, there are some other areas that do benefit from the tech spending as well, or the AI spending, which is infrastructure and improvements to the electricity grid. So there are some industrial companies and part of the industrial sector that focuses on infrastructure, really benefits from that. We think a lot of companies are actually going to benefit from the productivity gains, which we think will start to be apparent in the data probably next year from implementation of AI. So we expect this to be much more broad-based than we're seeing in the early stages. In the early stages, the number of winners tends to be relatively narrow, but we think this is going to broaden out as we go throughout toward the end of the year and into next year.
Makes a lot of sense, of course, just by the sectors where big tech is spending money. But let's talk about what you don't like, because I found this curious in your notes. You write that you're cautious on consumer staples, and I found that a bit unintuitive, because you think about the state of the economy right now. You have relatively sticky inflation. Prices are much higher than they were just a couple of years ago, and you have a pinched consumer. Wouldn't it make sense that consumer staples would kind of be the play here?
Well, there's a lot going on in consumer staples, but we do see the multiples there as relatively high. The growth is low. And we do have some pinched consumers on the lower end of the socioeconomic spectrum, but a lot of consumers are trading down. A lot of consumers are looking for a deal. I think you saw that in the May retail sales numbers. And if consumers are looking for a deal, that's not necessarily going to flow to the top brand names that are a big part of that consumer staples sector. So we think there is somewhat of a trade down that's happening, or likely to continue to happen, in consumer staples, and that might pressure the overall area. And without much growth and supporting relatively high multiples, I think investors are going to look to where the growth actually is.
And do you follow that trade down? Is that an investable trend that we're seeing?
In consumer staples, is that the...
Or just when you think about across industries right now, you're seeing it in retail, you're seeing it in restaurants, for example, that trade down. I mean, do you go to those sort of lower rung, maybe discount sort of offerings?
Well, that's a challenge to do as well. That's a tricky trade to play. The trade down play is tricky, because you might think that some areas should benefit, but it also turns out sometimes you find that those areas that get a proportion of the trade down play also lose a proportion of consumers, because they're just strained at those lower end of the spectrum. We think that's just a tricky place, and you're probably better off just staying away from that trade down play, both for the companies where the trade down is going away from them and even supposedly toward them. It's just a tricky area to navigate.
Yeah, fair point there, that it's tough to pick the winners in the trade down scenario. But let's talk about what seems like it's been an easy trade over the past couple of years, and that's cash, earning 5%. How are you feeling about cash levels right now when you think about overall portfolio allocation?
Well, we like staying invested here. We think the dynamics of the market between having earnings growth, a stable economic backdrop and labor market, inflation falling, corporations starting to spend more money, both on AI and otherwise. We like the idea of staying invested and not trying to hunker down in cash. But for those investors that cash gives some extra comfort to, we do think it is a big benefit, not just to investors, but to the economy overall, that you're getting a pretty good return just from sitting in cash, and it's a return that is well above inflation. So that is actually helping to support spending in the economy. I think there's about $140, $150 billion per quarter that investors are getting just from bank interest paid on bank accounts relative to where we were a couple of years ago, and that just supports spending the economy. So overall, it's okay to hold some cash, especially now when you have the returns on those cash being much higher than inflation.
And as of the latest reading, $6.1 trillion still held in money market funds. Young-Yu Ma, really enjoyed this conversation. Have a great weekend when you get there. That, of course, is Young-Yu Ma of BMO Wealth Management. And joining us now with a look at the stocks moving ahead of the opening bell, let's get to Abigail Doolittle.
Well, Katie, the major indexes here in the pre-market barely moving, but beneath that benign surface, we have some outsized movers, including the shares of Sarepta Therapeutics, up more than 30%, heading to the best day in 5 years. This after one of their therapies for muscular dystrophy was approved for a broader purpose. Some analysts saying it's the best case scenario. Those shares right now up 33%. Again, the best day potentially in 5 years. CarMax also trading higher. They beat earnings for the most recent quarter just slightly. Most analysts saying it was an inline quarter, but with this reaction for the stock, it seems as though there's maybe a bit of relief. And then one reason we have futures down, NVIDIA heading to a potential second down day in a row. Yesterday down more than 3%. Maybe a little bit of consolidation of what had been a 180% rally on the year, still pretty close to that. And then, of course, Katie, you were mentioning the fact that it's triple witching, the rebalancing, lots of volume and volatility. That could also be a factor in why there's some repositioning NVIDIA. That stock right now down in the pre-market.
Down in the pre-market, and certainly that's weighing on futures as well. Abigail, thank you. Now coming up, the SoftBank founder says he has plans to bring about an era of artificial super intelligence. More on those plans next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build. So it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Shareholders, don't worry about that SoftBank share price stuff. Dream's a big dream. Why don't you support Masayoshi Son, who has a big dream? I was born to realize ASI. AGI stimulates AGI and drive evolution. Less than 10 years, ASI will come.
And that, of course, was the founder of SoftBank speaking at the company's annual general meeting earlier this morning. And for more on Sun's ambitious plan to get into AI, we're joined now by Bloomberg Technology co-host Ed Ludlow. And Ed, it wasn't AI, it was ASI, which is artificial super intelligence. What exactly is that?
Well, by his own definition, it's AI that's 10,000 times more powerful than the human brain.
Oh.
You know, it's an interesting moment in time for SoftBank, right? Because they are riding higher as a conglomerate or as a startup investor than they have done for quite some time, largely because of the performance of their investment in ARM Holdings, ARM being a chip design firm that has itself convinced investors it's going to be a central part of the AI story. And, you know, I think you and I were talking off air about, like, well, what do we actually learn from SoftBank overnight? And if there's only one substantive thing, it's probably that SoftBank's bet on ARM is the focus of their AI strategy. In other words, they think that all of the chips that ARM will design will be leaders in the fields for data center chips or robotics chips or all the other hardware plays that we're seeing right now in AI. But what I found so interesting overnight is no matter how emotional Masayoshi Son was, he literally said to investors, root for me, I have a big dream. They were more interested in shareholder returns, which is a bit sort of beige, but important in this environment.
Yeah, according to our reporting, Sun at times was visibly overtaken with emotion. And I mean, like you said, he laid out a really grand vision here. He obviously has huge ambitions, but not a lot of details on what the actual plans are here, Ed.
Yeah, I think a lot of investors would look at the share price. The Japan-listed shares are up, I think, around 60% year to date. Their net asset values have climbed back because remember that many of the bets that SoftBank has made on startups in all fields in recent years have not paid off, and they have recovered largely on the back of their majority holding in ARM. And so you look at the chart on your screen of where the elevated share price is, that is in yen, and lots of investors asked him throughout the AGM about stock split, share buyback, dividend, and he said, just don't worry about it. Don't worry about that. Think about my dream. I'm giving you my dream. But remember, in the background, Elliott, a familiar name to us on this program, has built a more than $2 billion stake in SoftBank. They're returning for a second time as an activist, and they just want buybacks. They want shareholder returns because you look at that chart, and to many, that would be justified.
And that just seems so quaint when you think about really super intelligence and the evolution of humanity. But even still, I mean, talk a little bit more about that pressure, because you think about AI and outside of course, our humanity, I have to imagine there's a lot of opportunity to make money in that space.
Earlier this year in February, some colleagues at Bloomberg News and I reported that SoftBank has this big ambition, or actually Masayoshi Son has this big $100 billion ambition to dominate the semiconductor side of the AI story. That might sound familiar to you because it's something that Sam Altman of OpenAI, we have reported, is also thinking of doing to build up a big war chest. And he was asked about that, Masayoshi Son, during the AGM. He didn't explicitly acknowledge the project's code name and the specifics of it, but basically said he will do whatever it takes to get there. SoftBank's in a position right now where, again, we keep the chart on the screen, the share price gives him some wiggle room to fulfill this vision, but it's just not of interest to shareholders. And again, I call it beige, but think about the euphoria around NVIDIA's stock split and the access to retail investors got as part of that. And some of the other valuations that are driven by AI right now, NVIDIA's trading at 45 times forward earnings. You know, investors are basically saying, well, how long is it going to last? And give us some money back on the table, please, because we've supported you thus far.
I do love that tableau of course, Sun visibly emotional about sort of the promise of AI, and then you have shareholders saying, can we please talk about dividends? But in any case, you mentioned scaling up here, investments, et cetera, and I believe it was yesterday that we were talking about Dell with teasing this AI factory that they're going to build, and it just seems like there's an incredible arms race going on right now, Ed.
Yeah, the way I would think about it is quite clear that NVIDIA makes the GPU, the brain of what goes into a supercomputer that trains AI. And NVIDIA is kind of riding super high, but they have no experience or background in selling their products into the sort of rest of world channel. NVIDIA's stock performance and top line growth has largely been driven by 5 customers, which is the hyperscalers and Meta. Dell, by comparison, is very good at selling its products and services to small and medium enterprises and governments. And so basically, if somebody wants to buy NVIDIA GPUs or AI accelerators, you don't just knock on the door and say, Jensen, can I have some of those? You need an intermediary. And so there is some beneficial read-through that Dell and Supermicro and other server rack assemblers are going to get from that. The problem is that Jensen Huang also realizes this. He wants a bigger piece of the pie, and so NVIDIA is very much thinking about how they can just control the whole ecosystem themselves, become more of a systems vendor rather than just sell the GPU.
All right, Ed, it is always a joy to talk to you. You, of course, can catch Ed Ludlow on BTech at 11 a.m. Eastern. But coming up on this program, the morning calls, and later, Julian Emmanuel, Evercore ISI, the biggest bull on Wall Street with a year-end S&P 500 target of 6,000. But on the topic of AI, here's Howard Marks of Oaktree speaking about it earlier on Bloomberg TV.
Obviously, there's optimism surrounding AI today, and it is to some modest degree pervading the market. But I think that AI will not have a profound impact on non-AI companies for a good period of time.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
All right, it's time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. And first up, we have Bernstein downgrading Northrop Grumman to market perform. The analyst doesn't see any immediate catalysts on the horizon as the Department of Defense's budget gets constrained in Congress. Next up, we have Craig Hallam upgrading Penn Entertainment. The analyst says that M&A and activist interest provides a compelling opportunity for the stock. Even still, currently down about 1% in the pre-market. And finally, we have Monness Crespi cutting its recommendation on Palantir to a sell. The analyst cites the big data company's, quote, gluttonous valuation. And I mean, some of that is getting worked off right now. Palantir currently off by about 3.4% before the bell rings. Let's get a check on the markets. We are just minutes away from the opening bell. And you can see the S&P 500 taking a bit of a breather here. We saw its record run break a little bit yesterday, closing about 0.3% down and currently off by about 0.1%. Of course, we are still on track to close out a third straight week of gains unless something amazing happens. And of course, it is triple witching day, so you never know. But in any case, you take a look at the NASDAQ 100 right now, currently flat in the pre-market. And then small caps, we haven't seen this in a while, relative outperformer on the day. Now coming up, the biggest bull on the street. We'll speak to Julian Emanuel of Evercore about his 6,000 price target for the S&P 500. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the countdown to the open. I'm Katie Greifeld. We are moments away from the start of trading. You look at where we stand, and we're a little bit lower on the S&P 500, down about 0.2%, pretty much unchanged on the NASDAQ 100, but still biased lower. And small caps, they were rising in the pre-market, but fading a little bit, of course, as that bell rings. So let's take a look at what's going on outside of equities right now. You take a look at FX. You can see Euro USD, that pair, down to 106 right now. You take a look at your 10-year Treasury yield. A little bit of a rally building in the bond market. 10-year yields currently off by about 3 basis points, and crude pretty quiet this morning, currently up by just 0.1%. Now, one stock to watch at the open is Spirit AeroSystems, soaring after a report that Boeing is near a deal to buy back the aircraft parts supplier. Abigail Doolittle has more.
And Katie, this of course isn't really new news. It's just confirmation of what we've been hearing for quite some time. Off of the September of last year lows, more than a double for Spirit AeroSystems. So again, some of this priced in. Right now, the stock up about 5.2%. So a very good day indeed. I'll actually be able to see exactly since how long using the SINS function within the Bloomberg terminal. It is the best day since March 20 of this year. So investors liking it. But the relief is about the idea that there is this report, Reuters saying that Boeing is nearing a deal to buy back the aircraft parts supplier in terms of splitting the different programs, and then Airbus will take another. And then there's a possibility that a third category of programs may be sold or dealt with separately. Since this stock was spun out back in 2007 or so, into today, up about 30%. But between there and now, lots of moves up and down. I think investors really like the certainty of what's happening here, Katie.
Yeah, some needed relief for that stock, of course, down pretty mightily over the past year. Abigail Doolittle, thank you so much. Meanwhile, earnings season never ends because CarMax out with results this morning. Let's bring in Bloomberg's Jess Manton.
Well, taking a look at CarMax this morning, Katie, that stock up more than 3%. So this is a key company to look at because when you think about the Federal Reserve's trajectory with interest rates, obviously we know that when it comes to used car dealers, especially CarMax, because it is the biggest one in the U.S. and the pressures that came under, especially during the pandemic and then coming out of that, when it comes to new car sales, there's been a lot of improvements there just because a lot of those used car dealers have been issuing different sort of deals to get consumers to come back in. But when it comes to the used car side, even though you are seeing a profit beat there, but it offset a sales miss, when you look at this, especially when you think about affordability when it comes to some of these used cars, if you look toward the end of last year, the average was close to around 30,000. Now it's hovering around 26,000. So of course still pricey, but they are seeing those affordability improvements there, which is crucial. And especially when you think about what the trajectory of when it comes to the Federal Reserve potentially trimming borrowing costs later this year and what that could mean for the company. If you look over to some of its rivals, so if you look at, say, AutoZone, that stock is actually up just about 0.4%. We know Carvana can be quite volatile, but that stock's down about 1% there. And then when you look at the sub-industry group, when it comes to auto retailers right now, it's up about 0.8% for that group in the S&P 500. And of course, I can't leave out when it comes to buyback programs. It did reinstate that at the end of last year, and it said in this prior quarter that it did buy back about $100 million of stock, Katie.
All right, Jess Menton, always great to see you. Thank you for that. And in the next hour, we'll be talking cars with the CEO of Ferrari. That's coming at about 10:10 a.m. But before we get there, finally, let's talk about Sarepta Therapeutics soaring after the FDA approved expanded use of the company's gene therapy. Natalia Kunichevich joins us now with more.
So the stock is up by 30% today. This is a huge win for the company. Basically, this gene therapy called Elevidys is for children aged 4 and above to treat DMD, Duchenne muscular dystrophy. It's been very controversial, this whole approval process. Basically, it failed phase 2 and phase 3, which is a benchmark. However, this therapy showed really good results during some of its secondary analysis. Eventually, FDA granted an accelerated approval process, which is basically a shortcut to get drugs for devastating diseases to the market. So this drug therapy has been available on the market since last year, but only for children, to treat children 4 and 5 year olds, but now it's approved for patients who are at least 4 years old, but with no upper age limits. What it means for the company, basically that was the main thesis why investors have been holding this stock for a few years. It will accelerate sales dramatically, analysts are saying, and even during this timeline when this drug was available, but that was a kind of like a limited availability for some patients, it generated sales of about $200 million. Now analysts are seeing more upside, and that is the reason why the stock got a few upgrades in the past few days. Now it says it has about 18 buys, 3 holds, and 0 sells. Up to date, year to date, the stock is up by 65%, Katie.
Yeah, and currently looking at its best one-day performance since May 2023. We'll see if that one holds. Natalia, really appreciate that update. And let's zoom out to the broader market right now, because earlier this week, a number of strategists raised their year-end price targets on the S&P 500. The highest now sits at 6,000. And joining us now is the man behind the call. His name is Julian Emanuel. He is Chief Equity Derivatives and Quant Strategist over at Evercore. Great to see you in person.
Great to be here, Katie.
Let's talk about the big call heard around Wall Street, because you went from 4,750 to 6,000. Show your math here. What gets us to 6,000 by year end?
So I think when we step away from it, okay, and clearly this is something that there's an element of stepping out of one's comfort zone because we consider valuation to be a rather large part of the puzzle. But in going back and looking at history, valuation alone has not been a reason specifically to sell stocks. And frankly, in an environment where we think the AI revolution is really in its early stages, just an example here, we've been giving a series of webinars about macro topics for the last 6 months, and the company introduced an AI device about 2 weeks ago. We were able to take 45 minutes worth of a conversation and distill it in 3 minutes. And so for me, that was sort of a crystallization of how this technology is going to really enhance productivity. And so for us, the combination of that, the combination of the fact that we are, in our view, nowhere near a bubble, and the idea that past expensive markets have gone on for 1.5 to 2 years and have gone 40 to 60% higher, and this one is only 6 months old, based on crossing 20 times trailing earnings, and has only risen 11% from there. we think there's more to go.
I do want to get to the bubble talk, but let's talk about AI a little bit more and the revolution that is AI, because some of the themes that you're highlighting, you could have made that case at the start of 2024. So did anything change in the past couple months, or is it just your own experience with AI that really informed this?
Well, and to be fair, we did make the case throughout 2023. Actually, we were reasonably early to identifying the significance of it. But frankly, it's sort of anecdotal. It's talking with clients and corporates, and it's personal use that you can actually see the benefits accruing. And I think it's fair to say that that was the same sort of mentality that hit people in the late 1990s and the early 00s, even after share prices had turned down with regard to the internet, and the long-run implications for productivity are quite significant in our view.
And you mentioned that, I mean, high valuations are something that you kind of had to digest here. And I was actually speaking just casually with a portfolio manager yesterday, and we were talking about NVIDIA, and they haven't invested in NVIDIA yet. And they said, how do you buy NVIDIA right now? Basically at all-time highs, really briefly becoming the world's most valuable company. And I'm curious, I mean, how do you square FOMO versus really just the valuations? Do you just have to hold your nose and buy here?
So there are certain stocks, and that's certainly one of them, given the gains, where it's very difficult, particularly if you've got, a multi-week or a multi-month horizon. An entry point could be challenged here, but you really have to think about the long term and the implications of where the technology is going. And as well, when we talk about the stocks that we consider AI revolutionaries, we also include companies in other industries that have been very front forward about implementing the technology and showing how, A, it controls costs, but more importantly, how it actually engages and really elevates the customer connectivity experience.
Yeah, I do find that a fascinating narrative. The broadening of the AI rally, maybe not the overall rally, we haven't seen that yet, but just where AI could actually influence other parts of the market. Let's talk a little bit more about the underpinnings of this 6,000 call, though, because you also notched up EPS forecast from $231 for the S&P 500 to $238. Where is that growth coming from? Is that just tech?
To a large extent, it is right now. But when we look out, it's our expectation as we get into 2025 that we'll have a broadening, okay? We've seen a bit of a broadening over the last several months in terms of share prices participating, although small caps continue to lag a bit. But we actually do think as the economy continues on this sustainable path, if there is a minor downturn, the Fed will be there to, with plenty of ammunition to mitigate against the downturn. But B, the economy is on a path where we do think that earnings will broaden out.
Yeah, for better or worse, that Fed put, it still exists, it sounds like.
Look, for about a year and a half, the Fed wanted to say that it didn't, but frankly, and if you think about it, it continues to be an inflation story. And this environment is unique in that actually long-term rates have risen since the Fed's last hike last July. The market unusually is not looking towards a material slowdown, but yet the Fed is still there if inflation cooperates as we think it will.
Let's talk about bubbles. Like you said, this isn't a bubble, and we're lacking some pretty key ingredients here when it comes to M&A, for example, and when it comes to IPOs. We really still haven't seen those companies come out of the pipeline. What do you make of that?
Essentially, there could be a part of it is the capital markets are waiting to see what's going to unfold in Washington. This is, as we know, a reasonably consequential year for politics, and so that's an unfolding story. But again, it is part and parcel of most sort of climactic emotional rallies, which this one is not, that you do get M&A activity and IPO activity. And frankly, when you look at the bullish sentiment readings, they're not there yet either, which, again, is heartening to us.
And I feel like depending on how I wake up in the morning, I could feel like the lack of IPOs is either bullish or bearish, because it could be taken bullish as in, okay, we're not in a bubble. It could be bearish as in, what do these companies see that is keeping them out of the public markets, keeping them from leaving that pipeline? I mean, how has your view on that evolved?
Well, I think, look, the private markets have been very robust. We know that there's been swings in valuation over the last 4 or 5 years, but ultimately, you know, as in past cycles, the eventual strategy for a good swath of those companies will be going public. And we do think that that is part of the calculus. And then, of course, on the M&A front, there's just a huge amount of cash on hand in corporate America that, you know, whether it's AI-driven or just, you know, other forms of synergies, we do think that that cycle will reappear before this, you know, rally ends up peaking.
And Julian, before I let you go, I do want to talk a little bit more about private markets, because I'm having to pay a lot more attention to them, not just when it comes to private credit, but to that point, it feels like private markets are extremely hot right now and they're getting bigger. And obviously you live in public markets, but are you finding yourself paying attention more to those still private companies?
Well, you have to, and particularly on the credit side, because I think that you know, the shift towards credit, both public and private, has been very material since the pandemic, really driven by actually long-term rates going so close to zero as they did in 2020. And there will be liquidity issues at some point. There always are in every cycle, but we think we're a long way away from that. And frankly, the resilience of the credit markets has been part of this ongoing story of the rally in the stock market.
All right, Julian, I think that's a good place to leave it. Great to see you. Thank you for joining us on this Friday. That, of course, is Julian Emanuel of Evercore ISI. Now, coming up, we're going to dive into U.S. PMIs next. This is Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that...
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The latest U.S. PMI numbers just crossing the Bloomberg terminal, and it looks like a beat across the board. Let's get to Michael McKee. He is Bloomberg Chief Economics and Policy Correspondent. And walk us through these numbers, Mike.
Well, we've been hearing from a lot of people who think the economy is slowing and the Fed's going to have to act, but not with these numbers here. The manufacturing PMI from S&P comes in at 51.7, up from 51.3, and the services 55.1 from 54.8. The composite then ends up at 54.6 from 54.5. So still strength in manufacturing services and the overall economy, according to S&P Global. Now, this makes the U.S. an outlier with the rest of the world because we got European PMIs today that did not look so good. Pretty much in every country, France, Germany, the UK, and the European Union as a whole, we saw declines. So in manufacturing services and composites. So it is not a particularly global effect. It's the U.S. as the strong outlier, Katie.
Yeah, and I mean, I feel like I keep asking you, when do we start to worry about growth in the U.S.? When do we go from worrying about inflation to worrying about growth? And I'm not really seeing it in these numbers at all.
Not today, at least. We'll try again next week if you want something to worry about.
And let's talk a little bit more about that divergence that we're seeing between the big global developed economies. You mentioned, of course, Eurozone activity. It slowed in the latest reading. And you think about the divergence in the economies going to lead to a divergence in the central banks, at least for the next couple months.
Well, the ECB, the European Central Bank, did cut rates once, but they're being reluctant in terms of trying to give people clues to another cut anytime soon. Their inflation story is a lot different from ours because they use the harmonized version of the CPI, which takes out much of the housing calculation the U.S. uses. If you did the same calculation, right now, the U.S. headline CPI would be 1.95%. I did that calculation this morning. So they're in a completely kind of different situation. And then you got the United Kingdom as sort of an outlier on all of them because of the other issues they're having. And of course, the election's going to make a bigger splash than the Bank of England did this week.
Well, that's exactly where I wanted to go because we talk about political and election risk when it comes to the U.S. all the time and how that factors into the Fed's thinking. Take us over to what's going on with France. How are we seeing that effect both in the economy and potentially at the central bank level?
Well, it's an interesting situation because basically Emmanuel Macron, when he called the snap election, they figured that the right, the Le Pen group the National Front would be the main challenger, but then the leftist parties all got together and formed an alliance, and so now he's got problems on both sides, and so do the markets, because the markets see both the far left and the far right as willing to spend a lot more money, and France is already in a deep deficit hole, so there are questions about what's actually going to happen, and the argument there is sort of the same as the argument here in terms of some of the politicians and their promises, that these are promises, don't worry, they're not going to happen, but it has boosted the spread between France and Germany and the yield curve, although when you look at it, France is only in the 3% range. The U.S. is well over 4% for its 10-year. So is it as bad? Well, we'll have to find out.
All right, yeah, definitely something to watch there over the next couple weeks and months. Mike McKee, have a great weekend. Meanwhile, take a look at the market reaction to those U.S. PMIs. Again, a beat across the board. You do see yields rise a little bit here, still lower on the day, but a little bit of a reaction in the bond market. Let's go back to the equity market, though. And for some of the sector price action, Abigail Doolittle joins us now.
So right now we're looking at the S&P 500 down slightly, down about 0.3%. More of the sectors are higher, including staples. That, of course, there was a defensive sector, as is healthcare and utilities, services, communications, communication services and discretionary and energy in there, but no big gains. What I'd really like to highlight is take a look at that tech weakness, down 1.1%. Now, a piece of this is NVIDIA. Today, down about 5%. Over the last 2 days, down 7.7%, the worst 2 days since April 19th. And if we take a look at what's happening for Apple, because that was another one that did an interesting reversal yesterday, actually that one right now is a little bit higher, offsetting some of that NVIDIA weakness and the AI weakness. Taking it to the week, Katie, let's take a look at some of the subsectors. So we are looking at an up week right now, at least for the S&P 500. We have the casino sector up 4.4%, oil service index going up with energy up about 3%. But take a look at some of the weakness right there for that tech index. That is super interesting. I'm guessing, and I'm going to put it in as quickly as possible here, that the information tech index down on the week, down 1%. Most of that is coming from to today, and that is the worst week for tech going back to, well, it's actually not that far back, just 3 weeks ago. We also have real estate lower and the home builders down as well, Katie.
All right, Abigail Doolittle, thank you so much. Coming up, the market-moving events you need to be watching next in our Trading Diary. This is Bloomberg.
multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
All right, it's time now for the Trading Diary. What you need to be watching today and next week. We get existing home sales at the top of the hour, and then next week on Tuesday, the World Economic Forum begins in China. Wednesday, we get May new home sales. Thursday, it's the first debate between President Joe Biden and challenger Donald Trump. And then we round out the week Friday with PCE. Meanwhile, you take a look at markets right now. The S&P 500 building on losses just about 30 minutes into the session. You can see currently down about 0.3%. And all those small cap gains we were talking about in the pre-market, they're gone now. The Russell 2000 down about 0.4%, and the NASDAQ 100, it's your laggard on the day. The NASDAQ 100 currently off by about 0.5%. Now, this was the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.
the linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We made it. It's Friday. We're also streaming live on YouTube, so you can head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Coming up, we're going to check in with Vince Signorelli. He's our market strategist here, get a sense of what's happening on this Friday trading. Steve Mann from Bloomberg Intelligence, he's going to talk to us about the electric car market, electric vehicle market, and tariffs. More tariffs, this time coming from Canada. George Ferguson, he covers aerospace and defense for Bloomberg Intelligence. He's going to talk to us about Boeing. I think Boeing's trying to buy in some or all of this Spirit Aerospace, kind of bring that supply chain more in-house to maybe get a better handle on the quality here. So we got a lot coming up in the next couple of hours. Right now, we also have some Supreme Court decisions we may be getting today.
Yeah,
I mean, don't
look
they
at
have to
that
do
on a Friday.
in June? Yeah.
Yeah. They have like 1.5 more weeks. It's like total crunch time. It's
But
like
they have
let's
19.
hustle.
They have 19 cases to rule on. So maybe we'll get some stuff today. If we do, then June Grosso is going to help us out with that. But let's kick everything off with Lisa Mateo on the Bloomberg Business Flash.
You got it at Market Drivers, brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. All right, Wall Street bracing for the triple witching, where derivatives contracts tied to equities, index options, futures, they expire. About $5.5 trillion set to mature today. So let's get to the markets right now. We have the NASDAQ down 0.2%, 50 points at 17,673. We have the Dow up 0.1% or 48 points at 39,182. The S&P 500 down 0.2%, 11 points at 5,461. We'll head to the 2-year yield, 4.72%, down 1 basis point. The yield on the 10-year, 4.25%, and that is little change. We have spot gold lower, 2,335 an ounce. Brent crude crude $85 a barrel, WTI crude $81 a barrel. Economic data, existing home sales for May, let's start there, fell 0.7% to 4.11 million. Then we have U.S. services activity, picked up early last month to the fastest pace, more than 2 years. That outlook improved on cooler price pressures, prospects for lower borrowing costs. But let's get to the numbers. So you have the S&P Global U.S. Services PMI for June. Survey was for 54, came in at 55.1. S&P Global U.S. Manufacturing PMI, that survey was for 51 even, came in at 51.7. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo, Alex Steele, alongside Paul Sweeney. Happy Friday. We made it.
Summer Friday.
Summer Friday. It's triple witching, which just means that stuff will happen in the market. Lots of options expiring.
See, Lisa, I was trying to explain it this morning to Lisa, and I said, I've been doing the stock market thing for 38 years. I don't even know what it is. I mean, I just know, maybe some volume, maybe some volatility. I just want my book to be really tight by 3 o'clock. I don't want to have any kind of willy-nilly stuff out there on my book because something may happen. That's all I know about it.
No, it's fair enough. I know it because people write it in and say it, and then I think it sounds like a good number.
Okay.
But anyway, the point is options expire across a lot of different things, and so that might create some volatility, maybe some more volume. And then next week, I'm interested in this, we get the Russell 2000 rebalancing.
Yes.
And some of the big guys, like Supermicro, for example, will probably go into the Russell 1000. So the Russell 2000, like what's going to happen there once you take out these heavyweights?
This Supreme Court watch is it feels like a waste of time. Supreme Court rejects state's Rio Grande water settlement. I'm not going there.
I have no idea. We're going to find out what that means, but we don't know what that means.
Aren't there some bigger, more juicier stuff out there?
Oh, yeah.
All right,
All
right.
The Chevron doctrine, there's a lot of stuff going on.
Yeah.
All right, let's get back to, triple witching.
Yes.
Maybe Vince Signorelli cares. He's Bloomberg macro
Yes.
strategist, and he joins us now. Vince, do you care about triple witching?
I honestly, like Paul, to some extent, have absolutely never really cared about triple witching.
That's fair.
Because it's always a toss-up. Does it move markets? Is it more volatile? Does anything really change? And everybody gets so ginned up about it, and more times than not, nothing actually happens. But this time, famous phrase, could be different. There's 11 times more call options expiring than put options. Depending upon how traders want to play that when those options expire. Do they want to roll those positions? Do they want to sell covered calls? Do they want to buy puts? We have to assume, given the rally, that those options are more than likely than not in the money. Or are they going to just exercise those options, cash out, sell into the cash or the futures market, and close the trades out? So anything can happen, really, and there's no real way to know, until we get there. But then, like I said, sometimes absolutely nothing happens.
Vince, what's kind of the narrative? I'm trying to get a sense of the narrative of the drivers of this market here, whether it's the bond market or the equity market. Are we kind of teeing up what the Fed's going to do? Are we still on Fed watch? Are we focused on earnings? Are we looking at geopolitics? Is there something driving this market? Or are we just kind of treading water here?
Yeah, it's NVIDIA.
Yeah.
That's all the traders are talking about is NVIDIA. We mentioned this yesterday, that at one point their market cap was larger than both the UK and the French markets combined. So obviously it's, you've got to believe it's a little stretched. But the reality of the situation is we've got earnings coming up, in about a month, I think, for the second quarter. And yeah, traders obviously do look at earnings. And they're expected to be once again improved. Now, is that a low bar that we usually set for that? Yeah. So we almost make it impossible for earnings not to beat. But at the same time, I would think markets are obsessed with the Fed with this 25 basis rate cut. We're almost 300 points from our start of the neutral rate. So from a standpoint of what is that really going to do for the economy? 25 basis points, not going to make me run out and want to get a mortgage or refinance or buy a car. It's maybe gin up animal spirits in investors thinking we're now starting an easing cycle. But in terms of enhancing economic growth, I think it does next to nothing. So I would say we're way past the time now where the Fed needs to cut. Despite despite the S&P numbers that we saw this morning, I think the economy is really slowing.
Where else do you see the data for that?
So, it was an interesting survey out by resumebuilder.com that found that, let me see if I get the number right, 3 in 10 job postings, which feeds into Joel's data, are fake. And hiring managers, and 7 out of 10 hiring managers approve of this practice and think it's morally acceptable because it lifts the spirits of their employees. And thinking that there are job openings, the company's doing well, and there's going to be hiring to help them do their jobs, if you will. So if you just extrapolate that and maybe say, the job opening data may be inflated by 30%, then the economy's a lot slower than the Fed may be thinking, because that definitely feeds into Powell's thinking as to the strength of the labor market. So if the labor market isn't really as strong as you think it is, and the overall economy isn't as strong as you think it is, 300 basis points above neutral is way too far, and the Fed should be probably cutting by 50 basis points and starting pretty soon. It may very well be they've missed the mark again, and they've waited too long. And unless they get on an aggressive cycle, if this economy starts to turn, there's not a lot that they're going to be able to do about it.
All right, Vince, we appreciate you. Thank you very much. Have a great weekend. Are you barbecuing this weekend?
Probably, yeah, I would think so.
Okay, well, good luck with that in the heat. We support you. We'll be looking forward to some leftovers. Vince Signorella, Bloomberg macro strategist. I just want to point out here that NVIDIA is actually down on the week. We haven't seen that since April. I'm just saying. I wonder if there's any momentum that will happen around the close of that. Another headline that crossed earlier today is that Canada is apparently preparing tariffs on Chinese EVs after the U.S. and the EU did something relatively similar. We wanted to get more on that with Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. Hey, Steve, walk us through so far what we know on this.
Yeah, so Canada is basically following what the U.S. and the Europeans have done, which is to slap potentially 100% tariff, another 100% tariff on Chinese-made cars coming into Canada. Now, the impact is muted. First of all, Canada sells about 1.7 million vehicles a year, compared to around 16 million in the U.S., 30 million in Canada, in China. So the market is relatively small. I think the overall purpose of doing that is really to close the back door in the U.S., Mexico, Canada Free Trade Agreement, to make sure that Chinese cannot bring cars into the U.S. through Canada.
Oh, okay. Talk to us about the Chinese EV market, Steve. How big is it? You say you have a SAR there of 30 million cars a year. What's the share of EVs in today, and kind of where do you think it's going to go?
Yeah, it's pretty big. It's as much as 25% now.
Wow.
Of annual sales. So they've also, as you know, there's a lot of capacity in China, EV production capacity in China, and there's a lot of players out there. A few of them trade here, actually, NIO, XPeng, Li Auto. And so, the government, just to prop up consumer spending, have actually rolled out some incentives to sell more battery electric vehicles in China. And some of that incentives are, on trade-ins, extra credit on trading in their ICE vehicles for the battery electric vehicles. So, 25% now, probably expected to grow through the remainder of this year.
So here's my question. If I'm a Chinese EV company, can I then just go through Mexico? Because I appreciate this closes the window from Canada, so I can no longer really import into Canada and then through to the U.S. because the tariffs will hit. But in Mexico, I still can, right? So why not just ship all the EVs in there, free trade agreement, ship all the EVs into the U.S.?
That is true. But just like what Canada did, I think they're going to close that back door as well at some point. But look, the Chinese automakers, especially like BYD, has made it clear that they don't have any interest in entering the U.S. market at the moment, and it's difficult. It's not like you can say, oh, I'm coming in and selling cars in the U.S. and then you're able to gain a lot of customers just by doing that. They're gonna have to build a distribution network. They have to build a service network, and more importantly, given the geopolitical wrangling that's happening between the U.S. and China, I'm not sure if a lot of the U.S. Car consumer are ready to buy a Chinese car at the moment.
What do the Chinese automakers say, Steve, about these tariffs in the U.S., in the EU, Canada, I mean, to what extent, how impactful are these to their sales? And what are we hearing from these Chinese automakers?
Yeah, I think at the moment, zero impact from the tariffs in the U.S. and Canada. There will be some impact from the tariffs in the EU. They do have about 2-3% market share in the European Union. But you know, the tariffs is not as big as it is in the U.S. It's upwards of 38 to 50%, and it really depends on the automaker. For example, Stellantis, they do plan to import some Chinese-made EVs into Europe through their new joint venture with Leapmotor. So because Stellantis also has plans with Leapmotor within this joint venture to build cars in Europe, the tariffs is a little bit lower. So tariffs are different for different automakers within the EU. So the penetration rate will be impacted, but I think overall at the end of the day, Chinese will still able to sell cars in the EU, but at a higher cost and gives the incumbents some room to actually grow.
What do we think the differential would be? Like a China EV into Europe would cost X, and Volkswagen EV would cost Y. Like, what do we think that differential will actually wind up being?
Yeah, it ranges, I think, between 30 to 50% cheaper. The Chinese EV will be 30 to 50% cheaper.
Even with the tariffs or without the tariffs?
Oh, no, without the tariffs. So first of all, without the tariffs. And I think what the tariffs are trying to do, and not only the tariffs, any cars that actually comes into the EU from China will have to meet the local safety requirements. So there's going to be some changes that the Chinese automakers will have to make to their cars to meet those requirements. So overall, with the changes of the vehicles, with the tariffs, what the EU is trying to do is make ensure that the prices of the Chinese car, when they do hit the ground, will be very competitive to the EVs made by the local automakers there.
Hey, Steve, what's the latest thinking coming out of Detroit about electric vehicles? Obviously, a couple of years ago, they really started ramping up aggressively. Then demand seems to have faded here, so they're pulling back on some of their plans. What's the latest thinking from our U.S. automakers about their move to EVs?
Yeah, I was just in Detroit last week, I think the consensus is that battery EVs are here to stay. Some of the estimates that we saw a few years ago when we're thinking about BEVs going to hit 75-80% of the market is not unlikely to get there anytime soon. And if you look at global market, especially in the U.S., we're going to have a mix of powertrain, but BEV will grow. I think some of the estimates out there, including ours at BI, we think the U.S. market will probably hit 25 to 30% penetration rate by the end of the decade. So from about 9% today. So different automakers are taking different strategies. If you look at Stellantis, you look at GM, they're full on. They're still launching a lot of EVs in the next couple of years, more affordable EVs. Ford is taking a step back, right? I think it's not a bad strategy. They know the technology. They know how to build EVs. So it doesn't hurt. It saves cash for the time being until they see critical mass, and they can easily come back to the market.
All right, Steve, we appreciate it. Thank you so very much, Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst. You have to wonder, what policy, though? We were talking to the to Helion, right? And they used to make basic trucks, like EV trucks, right? And they said, look, the policy just wasn't there, and the demand just wasn't there, and we just couldn't sustain that part of the business. If we get a different administration, does that change? If we get different ruling and the EPA does different things, does that also change? Like, what part of policy plays in the demand?
Yeah, I think what we learned and what we're still learning is it's got to be price competitive.
Yes.
The charging storage situation is going to be vastly improved. And, you know, I also think there's still a political thing there that I'm not sure they're going to be able to get over.
Yeah.
I think there's going to be some kind of political divide there where people are going to go,
Yeah.
it's not into electric.
Right. It's going to be like a political stance versus like, oh, it's a cool, cheap car. I'm going to go buy it. All right, coming up, we're going to talk about Boeing and aerospace systems with George Ferguson, Bloomberg Intelligence senior aerospace, defense, and airlines analyst, how that merger will be coming or not. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Is the AI rally showing some signs of slowing? Some people are asking that. This after, though, the Bank of America strategist said that inflows into tech funds reached a weekly record of $8.7 billion. Let's check in. We have the S&P 500 right now down 0.1%, 6 points. We have the NASDAQ down 0.1%, or 27 points. The Dow right now up 0.2%, or 106 points. We have the 2-year yield at 4.73%. That's little change. The 10-year yield, 4.25%, and that is little change. Now, we talked about inflows into tech funds. Shares of NVIDIA, let's take a look there. They're lower They're lower right now, down about 3%, and this is after CEO Jensen Huang unloaded about 32 million shares of the company. Moving the markets right now, well, it's Sarepta Therapeutics. Their shares up 39%. Its gene therapy received expanded FDA approval, and Spirit AeroSystems, their shares right now, they are up 5%. Report that Boeing is near that deal to buy back the aircraft parts supplier. Boeing shares up about 0.2%. That's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much. Lisa Mateo, Alex Steele, Paul Sweeney here. We do have some breaking news from the Supreme Court. The Supreme Court upholds U.S. gun ban in domestic violence cases. Whether to strike down this federal gun ban for people subject to domestic violence restraining orders was the point in question. Let's go right now to June Grasso, who covers everything law and legal for us for Bloomberg Television and Radio. June, can you walk us through this?
Yeah, sure. So this is a case where a man who was subject to a domestic violence order wanted to get a gun, and there is a federal ban on that. But the Fifth Circuit, which has been pushing the law farther to the right than even the Supreme Court likes, said that's unconstitutional. And during the oral arguments, this is not so much of a surprise, because during the oral arguments, a majority of the justices seemed to think that it was this kind of restraint on owning a gun is logical. I mean, the case was really bad for the gun lobby, because the guy had, gone out into public and shot the gun off, and there was this restraining order. So what they're saying is, in this case, you can stop someone from having a gun. Gun restrictions have been up in the air for years since the Bruin case, the New York case, where the Supreme Court sort of toppled the way the courts analyze gun restrictions, and they base it on historical. So you'll see gun cases where they're talking about, well, was there something like this in the 1800s? It's sort of a crazy way. For me, it's a crazy way to do it.
Does this open a path for common sense gun legislation then? Because one could argue, this seems like pretty good common sense. I wouldn't want someone who's convicted of domestic violence having a gun. So if that's okay, can't we also say someone who has, I don't know, criminal record?
Bump stock, maybe?
Yeah.
See, that's what I mean. I don't think it translates with this court. I think this is sort of an exceptional situation, because we had that bump stock decision where they said even though it operates like a machine gun, the way it functions, they use the term function, and they use the dictionary to analyze what function meant, Justice Thomas. So, it would be nice to think that was the way that we have common sense gun regulations, but I'm not sure that that's what this stands for.
Well, I mean, at the end of the day, it says that, the Second Amendment isn't so broad that it protects the gun rights of those found to be dangerous. So now are we going to get into a situation where we have to define dangerous and what constitutes a human being dangerous? Is that what is going to come up now?
I mean, I really have no idea how this is going to play out, because it's one case. It's a case where the Fifth Circuit went out on a limb. And there are like more than 10 cases, I think, this term where the Fifth Circuit went on a limb, and the Supreme Court almost has to take the case, even if they don't want to take the case, because otherwise you have this, sort of abnormal law in place. So it's hard to say what the effect will be. I'm sure that in other gun restriction cases they'll use this to try to show that there are there are ways to get around it. I'll have to read the decision to see exactly how it came down, and it's by the Chief Justice. So that's a sign that it's not going to be one of those radical, hard to understand decisions by Clarence Thomas, or it's going to be sort of down the middle as you can get. So because he writes sort of reasoned opinions. So I think that, and I think that this is one that we expected, but still a big case. It's 8-1. I noticed Justice Thomas dissenting. There is not a gun law that Justice Thomas wants to see. No, really, he is. Consistently, he's the one who wrote that opinion, as I mentioned, on the Second Amendment, that broadened the Second Amendment to being able to carry handguns and the restrictions that New York put into place, throwing them out. So I mean, there's just not a gun law that he will ever say is. All
right, we should note that Michael Bloomberg, the founder and majority owner of Bloomberg LP, the parent company of Bloomberg Radio, is a donor to groups that support gun control, including Everytown for gun safety. So again, as you mentioned, June, 8-1 ruling. Does that surprise you?
Not really. I mean, the surprise is that Thomas didn't. The surprise is that even in this situation where you have a guy with a domestic violence restraining order threatening people, even then he said that he doesn't want any restriction. That's the only surprise. Otherwise, from the oral arguments, it seemed pretty clear that there were a majority of the justices that were going to allow this particular ban.
And we've been talking with June Grasso right now about the Supreme Court upholding the U.S. gun ban on domestic violent cases. It's an 8-1 ruling, as Paul was just mentioning. The justice is saying the constitutional Second Amendment isn't so broad that it protects the gun rights of those found to be dangerous. Justice Clarence Thomas was the lone dissenter. Okay, June, did we learn anything else today from the Supreme Court? They're like 5 days and ticking, right?
So when we were talking before, I said there are 19 cases, and basically 14 of them are controversial. And so today they came out with 5 decisions, 4 of which were not controversial at all, that we're really not tracking. I mean, some of them are interesting. One was about whether a U.S. citizen has a constitutional right to have her spouse declared a citizen. So that's an interesting case, particularly in light of what Joe Biden did this week relating to allowing spouses who are married to U.S. citizens who came to this country illegally to stay in the country while they go through the process. Normally, they'd have to go back to their home country, which is really risky. So it's interesting, but still, so we have 1 week left. So far, 1 decision day on Wednesday. I'm sure they'll have more coming up. They'll set more. But so we have all the cases left: presidential immunity, the January 6th obstruction charges, the Idaho abortion ban, the homelessness issue, Chevron case, which you mentioned before, the cases on social media, the case on Purdue Pharma, air pollution, SEC.
Why are they waiting, do you think? Is this typical?
All right, so it is typical. But so I was talking to a professor yesterday because I was questioning why they're all, and I always feel like they're waiting until the end and they get them all out at once and it gets lost in the ether. You can't cover everything at once. And but what people say is that, well, the more complicated cases with like 6-3, there'll be dissents, there'll be concurrences, and then they have to pass those around the justices, and so it takes longer. But this professor I was talking to, Harold Krantz, said, he thinks that the chief is holding them. And because if you notice yesterday, there were 4 cases. 3 of them were about criminal procedure. They were grouped together. So it's odd to me that this is just haphazard, random. They all come out. And the Rahimi case, the case that we heard today, was one of the oldest cases. It was heard in November. And usually you can tell how the cases come by when they're heard. So think about the Trump case. It took about 20 days on the last Trump case having to do with the ballot. We're up to like 40-something now on the Trump case. So it's a
all right, we'll pay attention next week. Okay.
Well, we'll be here.
We'll be here.
You're off Friday.
Off Friday.
All right.
Oh, that's going to be a big day.
That's
Maybe
gonna be a big day?
Maybe you wouldn't want to take it.
I'm going to prep. Now I got to double prep now. All right. June, thanks a lot. June Grasso joining us to help break it down. Just to reiterate, the Supreme Court upholds the U.S. gun ban in domestic violence cases. I should point out, Smith & Wesson shares are sliding over 12%, but that's also because they said sales in the first quarter would be 10% lower year on year than originally thought. So if you're just looking at the market for that kind of reaction. All right, let's get more on this with Andrew Willinger. He's Executive Director, Duke Center for Firearms Law. Andrew, thank you for joining us. We appreciate it. Can we get your reaction to this ruling?
Absolutely, yeah. So I think the big takeaway, of course, is that the court here upholds a federal law that restricts people who are under domestic violence restraining orders from possessing firearms. It's an 8-1 decision, so you have 8 justices in favor of that outcome. Justice Thomas is the sole dissenter, and I think what we were watching for, at least what I was watching for with this case, is sort of how broad the decision would be. And the court seems to settle on something akin to a dangerousness principle, where the majority basically says that when there's some evidence that a person poses a threat of harm to another person, then that individual can be barred from possessing guns consistent with history.
Andrew, is there any reason for any gun protection advocates to maybe read into this that, hey, this may create an opening for, more common sense gun legislation?
So I think having just had a chance to briefly skim the decision, my read is that it's somewhat narrow and that the court doesn't squarely confront, even other related issues like banning convicted felons from possessing guns, for example, those convicted of nonviolent felonies, and sort of leaves those for another day. I'll have to dig a little bit more into the various opinions because there are some concurrences as well that might shed light on where some of the specific justices are.
Well, I think it just also then raises the question then what is dangerous? So if you can't sell a firearm to someone who's dangerous, how are we going to be interpreting that through legislation and then through the courts?
Yeah, and my initial reaction to the decision is that, again, the court, the majority sort of leaves that question a little bit open. There was some discussion at the oral argument that this specific law doesn't really pose a difficult case because there has to be a finding by a state court judge that somebody is dangerous, is likely to commit domestic violence. So in other words, this would sort of be a case in the heartland of that principle, but there might be edge cases with regard to other types of gun regulation that the court will have to confront. And one takeaway, I think, one initial takeaway from this decision is it wouldn't surprise me if in the coming terms the court did confront some of those issues and decide those questions.
Andrew, what is the Duke Center for Firearms Law?
Yeah, absolutely. The Duke Center for Firearms Law is an academic organization that's housed at the law school here at Duke. And we seek to grow and build the scholarly field of firearms law in the legal academy. We also have a variety of resources on Second Amendment cases and other issues related to gun regulation that we host through our website, blog, and database of historical gun laws, for example.
Go ahead.
Andrew, with that background, and given what I know is, the majority of U.S. citizens favor common sense gun law, I think that's a fact. From your perspective at the Duke Center for Firearms Law, why can't more legislation, common sense gun laws, why can't they be enacted here in this country?
Yeah, so I mean, I think one obstacle to some of these laws has been the test, the legal test that the Supreme Court set forth 2 years ago, almost to the day, in a case called Bruin, which essentially says that the way courts are to evaluate Second Amendment challenges is by determining whether a law is consistent with historical tradition, and that, this decision today is the first we've heard from the Supreme Court since then on the Second Amendment. So their first sort of chance to clarify what that test should look like. And you have today 8 justices saying pretty clearly that, we're not requiring a twin. We're not requiring any kind of exact replica in the historical record to support a modern gun law. So I think that's important and consequential, and maybe to some extent the justices in the majority are concerned that their prior decision was interpreted that way by at least some lower court judges.
How do you think gun laws or the reaction to them evolve as it continues to seem more politicized? And I know that's even crazier to say because it was already so politicized, but so many more of the issues are now politicized. How do you think this evolves in this country?
Yeah, absolutely. To take it back to the Rahimi decision, I actually think this sort of illustrates maybe less of an ideological or political divide as to certain types of gun laws. This is maybe a law that has, we know it has very broad public support based on polling that restrictions on domestic violence offenders The vast majority of people in the country support those types of laws. And so today we have a decision upholding that regulation at the federal level. And so, I think there will certainly be other cases down the road that will be more of a stark, ideological divide. If you think about something like a restriction on semi-automatic rifles, so-called assault weapons, that would be an example where I would expect the court to really fracture along ideological lines, but that wasn't the case today.
When I was getting my MBA at Duke, Alex, I took one class at the Duke Law School. Big mistake.
Did you run away?
The kids work super duper hard. Like, I had to work in that case. My little study group wouldn't let me just skate by. They weren't like the business school where we were just punching our ticket to go back to Wall Street.
That's amazing.
These kids were like serious. So anyway, appreciate that.
So you're like, thanks for that, and see you guys later.
Yeah, exactly. All right, Andrew, thank you so much for joining us. Andrew Willinger, he's executive director of the Duke Center for Firearms Law. I should have just gone to like taken a class in like philosophy or something. Over
Yeah, totally.
But I went to the law school, which is right next door to the business school, and I took a good class on securities law. And the guy, one of the leading guys in it, Professor Cox, and I see him on TV all the time. But
wow, you remember all of this?
yeah, I remember getting to my study group, and all the kids come right out of college. None of them had work experience, whereas I've been on the street for 3 years. And so they were still very much in the student mode. Study. Whereas, again, at the business school, you work 3 or 4 years on Wall Street, and then you go back to business school just to punch your ticket so you could double your pay and go back to Wall Street. That was it, basically.
Right. So you weren't working while you were getting your MBA?
No, full time.
Okay.
And it got in the way of my golf down there. I mean,
That's tough stuff.
Yeah, so the classes were getting in the way in the golf and going to the beach and all that kind of stuff.
And to be fair, golf is very important for business people, right?
Exactly.
I mean, this is where the deals, the things happen.
This was in the late 80s, early 90s, back when Japan was still the bomb. They would send over dozens of kids to the business school, and all they would do was learn how to play golf. They got their professional golf guys to give them lessons. They'd be on the range every single day, and they weren't kidding. A big part of their U.S. MBA was to learn how to play golf.
I mean, I don't know what to say to that, because that's probably the most amazing thing that I've ever heard. But this just goes to your point that, like, you need to have the golf outfit. It's important. You can't have the classes get in your way of your game.
Right, exactly. So that's how we did it at Duke. That's not how they did it at Virginia. They prided themselves at Virginia Business School on working really hard. So I chose not to go to Virginia. I chose to go to Duke. Good choice.
Okay.
All right, let's go
I
to
learned
Lisa
so
Mateo.
much from Paul.
I know. Let's go to Lisa Mateo. She's going to give us a little bit of a reset here and give us a sense of what's happening in this
That's
market.
a tough. I learn something new every day from Paul. From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Right now, stocks, well, we've got red and green on the screen. This is after more economic data out today. Also, after we had some more Fed speak, we had Chicago Fed President Austin Goolsbee said that policymakers will be able to cut interest rates if inflation continues to moderate, while Minneapolis Chief Neil Kashkari said it could take a year or two to get prices down to the Fed's 2% target. Right now, the S&P 500 down about 0.2%, 11 points. The Dow up 0.1%, up 68 points. The NASDAQ down 0.3%, up 58 points. We head over to the 2-year yield, 4.74%. That's little change. The yield on the 10-year, 4.27%, and that is little changed as well. Commodities, we have spot gold lower at $2,336 an ounce. We have Brent crude at $86 a barrel. WTI crude, $81 a barrel. We have some news from American Express. They want to help you land that hard-to-get dinner reservation. The company has agreed to acquire Tock, which provides reservations for high-end restaurants for $400 million from Squarespace. And this one seems to make sense. Netflix getting into the popcorn business. It's partnering with Popcorn Indiana. It's going to launch Netflix Now Popping. Hit shelves at Walmart today. That is your Bloomberg Business Flash. Paul and Alex.
Well, thank you so much, Lisa Mateo. All the good stuff. Forget your story about law. I mean, let's be honest. Okay, so I was mentioning that we have the whole triple witching. Then Signorella poo-pooed that. So did Paul Sweeney. We have another thing today, and that is ETF rebalancing. So here's like the broad strokes. The State Street Global Advisors Tech ETF has to rebalance. It has about $71 billion in that. And the idea is that you're going to have to buy some NVIDIA and sell Apple, and it could kind of move individual stocks around. So we wanted to see if this was actually a big deal. Not like the triple witching thing. James Seifert is Bloomberg Intelligence ETF research analyst, and he joins us now. Okay, is it a big deal, this rebalancing?
I mean, I think it's a big deal. It kind of shows some of the issues with passive indexing, and there's a lot of things that people like to complain about with passive investing and passive indexing and things like that. And we spend a lot of our time pushing back, saying it's not as big of a deal as people are making it out to be. That said, I like to go back and kind of point out times where sometimes rules can be a little dumb, and situations happen where wonky things happen in the markets, and I think this is one of them. I mean, after market close today, our estimates are somewhere around that this XLK ETF is going to have to sell almost $13 billion worth of Apple and buy about $11 billion of NVIDIA. So, I mean, that's just wonky in itself, I guess I would say, but I'll stop there.
So, James, how do we get to this position? Doesn't XLK, this ETF, doesn't it do this stuff every day? Like if NVIDIA's going up, don't they buy more NVIDIA? I don't know how that works.
Yeah, so the way most of these passive indices work is they just hold these stocks in proportion to their market cap. So the size of the company, that's how much they hold. It's actually, we can get into the wonky parts of this a little bit too, but it's more about free float market cap, which we can get into in a bit. But essentially, theoretically, as the prices of the values of these stocks go up, the weighting in the fund will go up. But there's things that happen where you have to rebalance. So they rebalance quarterly. Different stocks get moved from different sectors, so they'll come out of the sector ETF. But theoretically, the way XLK works is it takes all the S&P 500 stocks that are in the tech sector and should market cap weight them. But there's these rules from the SEC that have to do with registered investment companies. So all mutual funds, ETFs, for the most part, fall under this registered investment companies ruling. And they have diversification requirements. The problem is if you just allowed these things to be market cap weighted, you have the three largest companies in the world in Microsoft, Apple, and NVIDIA, all around over $3 trillion in market cap valuation. And you'd end up with this fund being 60+% just in those three stocks. Wow. And the diversification rules and the index rules don't allow that. And the way they do that in this case is they just cap the smallest one. So if you're over a certain weight, 5%-ish, and if all of those stocks over 5% add up to over 50%, you cut the bottom one to 4.5% in the fund. So essentially that meant for the last 6 quarters, despite NVIDIA should have had a significant weight, every time it rebalanced, it got sold because it got capped at 4.5%. But last Friday, as of the market close, which is when this fund looks at this, on a free float adjusted basis, NVIDIA was larger than Apple. So all of a sudden, now Apple is that smallest stock. So NVIDIA is going to get a bunch of buys and Apple's going to get a bunch of sales. Ironically enough, today, with the way NVIDIA is trading down over 4%, it's actually smaller than Apple. So if the date was today, we wouldn't be having this rebalance.
So, okay, I'm still confused. Can we attribute any of the price action of Apple and NVIDIA in the past week to this?
So it's hard for me to know exactly what's going on, right? So there was a massive inflow that went into this fund that's in, there's rebalance flows. Money comes in and goes out, and it kind of happens over days as far as the rebalance goes. So it's called a reference date. That's the date. We're going to look at all the information from this date, and we're going to use that information to do the rebalance. So in that case, it was last Friday, June 14th. The actual rebalance is going to happen today after market close. But the people making markets know this is going to happen, right? It's not like this stuff happened and it closed on last Friday, and then no one's paying attention to this or trading around what's going to happen with these tens of billions of dollars being traded. Like things were happening Friday last week and all along this week. They were preparing for these trades. So it's most likely that Spider and anyone else that's tracking this index has the trade set up and lined up so they can match the underlying index. That's the ultimate goal of these passive funds. They want to track the underlying index. In this case, XLK, it's the large cap stocks in the S&P 500 that are in the tech sector.
Have we seen this before? This feels like I haven't read this, seen this, dealt with this before. Is this new? Unique?
Yes and no. So there are instances where wonky things like this happen. In many cases, they're with smaller stocks, though. So I've written in the past about some dividend funds, and there's wonky issues with dividend funds where if you're weighting it by dividend yield rather than market cap like this fund is weighted, as the price of the stock goes down, your dividend yield goes up. So basically what happens in some cases with those dividend yield funds or some other funds, some cash flow type funds, as they'll do cash flow yields and things like that, as the price of the stocks go down, it looks like their valuation metrics are getting better, but it's partially because the stock price is going down so much, and there's oftentimes reasons for that. And then many of these funds have like limitations. So if it goes below a certain market cap, we can't hold it. So all of a sudden they build up these massive positions and then it gets too small and then they're forced to dump it. And that's happened in the past. But it's rare. This is the first time I've ever seen it happen with a large cap ETF in a fund of this size, again, $71 billion, like Alex said at the beginning of this. So yes, it's rare. So that's why I said I like to point it out when it happens, but it doesn't usually happen. And the only reason it's happening is because we have this unique situation where they've taken a bunch of names that used to be in the technology sector and moved them out in a reclassification. So Visa and MasterCard are no longer in there, which are big funds. Right. Obviously, Google and Meta and other ones have left. So all of a sudden, you left with this really top heaviness at the top of the tech sector in these three stocks, and that's causing a lot of wonky things to happen. Now, the thing I'm watching is right now, like I said, if the reference date was today, this rebalance wouldn't be happening. NVIDIA would be the one being capped at 4.5%. The next rebalance is September. So if Apple manages to stay larger than NVIDIA on a float-adjusted basis in September, we're going to have the exact reverse of this. So usually these index providers, in this case S&P, and the ETF providers, in this case Spider or State Street, they try to keep the indexes exactly the same because they want continuity over time. I wouldn't be surprised if they look at kind of changing the rules about how they meet those diversification requirements rather than just arbitrary capping, chopping off the third largest here. So that'll be something to watch in the next few months. But if they don't, we could come to September and see like a reversal of this, or if Microsoft is somehow smaller than NVIDIA and Apple, that will be the one that gets sold, and Apple will be bought. It'll be very interesting to watch what's going to happen. And this is an area that hedge funds are paying very close attention to in making markets. You asked if it's actually impacting markets. There are whole teams out there that are watching for what these behemoth passive products are doing and what they're going to have to do in rebalance dates and basically prepping for it.
I want to see what like water cooler talk is with him and Eric Balchunas.
Oh, geek to
like,
the
yeah.
geek to the
And they're like, hey, bro, let's check out this ETF and look at this flow. It's so cool. I just joke because you guys are so smart and so insane when it comes to all of these details with ETFs. But this is really helpful, and we appreciate it. And thank you very much. And it really helps to understand what happens with an NVIDIA and an Apple when you have this kind of reshuffling, right? $71 billion, that ETF reshuffling, that's not nothing. And I'm looking forward to the Russell 2000. I feel like we should definitely talk about that next week, too. Especially the small caps who've just not been able to keep up. And any keep up they have is like super micro at that point.
Exactly.
All right, taking a look at the markets, a whole lot of nothing. You have the NASDAQ is down 0.1%. I feel like I've been saying that all week. Like nothing is happening. Volume is still high. It is triple witching, which they tell me things are going to move. There could be volatility. There could be volume, particularly around the close. Happy Friday. This is Bloomberg Intelligence.
your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Huawei's competition with Apple in the Chinese market heating up. The U.S. sanctioned company says it's closing in on 1 billion active consumer devices. Apple shares right now, they're up about 0.7%. Meanwhile, sources say China pushing for Visa and MasterCard to lower their bank card transaction fees in the country. It's part of an effort to make their payments easier for foreign visitors. And if you're car shopping, well, you better pack in the patience. It could take several more days for thousands of car dealers around the country to get their showrooms fully back up and running. CDK Systems, that's a software provider behind the backbone for their business. Well, it's been hit with back-to-back cyber attacks. Bloomberg's global autos editor, Craig Trudell, he explains why this is a big deal.
Basically, everything a dealer needs to run their day-to-day business is run through these dealer management systems, and there's only a handful of players, and so for one of them to go down, it's hugely disruptive to the car industry.
And sticking with cars, shares of CarMax, they're higher, up about 1.5%. First quarter profits stronger than expected. Its sales missed estimates. Nike reports earnings this week, and there's some mixed reviews. One analyst from Williams Trading is cutting his price target, telling investors to sell the stock, saying it's too expensive. Meanwhile, analysts at Oppenheimer, well, they have a different outlook. Bloomberg's Kriti Gupta explains.
The analyst saying Nike is on the mend and reinstating them as a top mega cap pick. So a real vote of approval or stamp of approval coming out of Oppenheimer that are moving the Nike shares.
And those shares up about 0.8%. And shares of Smith & Wesson, where they're down about 12%. The company said sales in its first quarter would be about 10% lower year over year. And some news from American Airlines. The company said it's suspending training for new pilots through the end of this year. That is your company news at this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business and finance through our lens of Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. We also keep you up to date on all the world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex, Paul, Lisa. The U.S. Supreme Court upheld a federal law that bars firearm possession by people under domestic violence restraining orders in a ruling that tempers the court's expansion of constitutional gun rights. Voting 8-1, the justices said the Constitution's Second Amendment isn't so broad that it protects the gun rights of those found to be dangerous. Justice Clarence Thomas was the lone dissenter. Bloomberg Law's June Grasso.
So we have all the cases left: presidential immunity, the January 6th obstruction charges, the Idaho abortion ban, the homelessness issue, Chevron case, which you mentioned before, the cases on social media, the case on Purdue Pharma, air pollution, SEC.
Bloomberg's June Grasso speaking to Alex and Paul. The Supreme Court also ruled federal courts can't second-guess visa denials for spouses of American citizens, even if it means the couple can't live together in the U.S. The wife of a man electrocuted in a hot tub at a resort in Mexico is speaking out about the incident. Lizette Zambrano was also in the tub and was badly injured. The Texas couple, they were with dozens of family members at the beach resort. She told ABC she is now suing the resort for wrongful death due to what she alleges was faulty wiring sending a live current into the water.
The last thing I remember him saying is, "Oh," and it's the same time that I felt the first electric shock. And then it happened over and over and over. I didn't hear him again.
The resort has denied responsibility, saying in a statement, in part, quote, "The Sonoran Sea is a condo resort and the Homeowners Association is responsible for all common areas, including the maintenance of the swimming pool, hot tubs, and grounds." Amtrak and New Jersey Transit Rail Service is facing significant delays for the third time in 4 days along the Northeast Corridor. An overhead power issue led to even more disruptions for commuters traveling in and out of New York City. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex, Lisa.
All right. Thank you so much, Michael Barr. So this amazing piece of news comes to me from Quinette. She's my executive producer for television. And here it is. there is a camp where women spend money to go and have a traditional camp experience. And they say it's absolute magic. So thank you, New York Post, by the way. So apparently it is a camp social, a woman-only adult summer camp in the Poconos. It costs $600 for a 2-day, 3-night stay. And you get juice boxes, no more. You have unlimited wine. You also have hair braiding. You have friendship making bracelets, which you would normally do in like a kid camp. Okay. There's also a camp social in France, in the south of France, where you can go and stay in a chateau, $2,300 for a 6-day, 5-night stay. I mean, thank you. This is amazing.
This is a good one. I mean, Camp Social has a roster of about 40,000 eager beaver wannabe campers.
They're waitlist longer than the pool at Dumbo House, is what the Post says.
Exactly.
Wow. So and you get food and everything with this whole thing. This is like a deal. This is the Poconos, Michael Barr.
Yeah,
I think
where is this thing in the
Linda's going to be going.
Well, I know. Yeah, Linda's going. There's Camp Bar at my house where we can shoot billiards ball. That's about it.
I mean, I think the whole point too is like it's exactly like you would do a sleepaway camp when you were a kid, but it's all adulted up. And you're not uncomfortable sleeping in a tent. Like you can actually sleep in like a place where your back doesn't hurt in the morning, and you can have like nice, nutritious breakfast, and then go play, I don't know, in the lake, in the river, and then make friendship bracelets.
It's glamping. I love it. I love it.
Camp Chateau. I like this one in the south of France.
You know what I think we should do? I think we should do an investigative piece on this, and Lisa and I should just go and test it out because we don't know, right? And we feel like this is important, or at least Bloomberg Pursuits maybe need to send us for some recon on this.
Yes,
we should do
charge
that.
it on the corporate card.
Yep, exactly.
Paul's like, charge it. All right, coming up, we're going to revisit the Supreme Court decision upholding that U.S. gun ban and domestic violence cases. You're listening to Bloomberg Intelligence. Happy Friday.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Greg Storr, Bloomberg Supreme Court reporter. Yes, we have a reporter that focuses just on the Supreme Court. He's going to join us with some of the SCOTUS rulings today. Jess Metten in studio. She's going to give us an update on what's happening in those markets. Nathan Dean's going to join us here and give us his outlook for U.S. financial policy about the financial services industry. What kind of policy can they expect coming out of Washington, D.C. here? And then it's Friday, and for me, the last time I will get to chat with Joe Misek. Joe Misek, editor of the Bloomberg Brief. He's retiring next week.
And you're off on
I will
Friday.
listen on Friday. So this will be the last time I get to chat with our good friend Joe Misek, the dean of newspaper reporters for the municipal bond industry. So he'll be in our studio here. That'll be very cool. Right now, let's get a Bloomberg Business Flash with Mr. Charlie Bell.
Much. Here's what's going on. We're looking at a mixed market right now. We got the Dow higher, up 53 right now, up by about 0.1%. S&P lower by a point, and right now we have got NASDAQ turning around higher by 2 points. Stock market, though, lower as tech comes under pressure. A pile of options expiring later today threatens to trigger sudden price swings. All eyes on NVIDIA. The stock down again today, down by another 2.1%.